Just a couple announcements and questions I had come up. First off, did all of you get the link for the midterm exam? Did all of you receive that email from me yesterday? If for some reason you did not, I sent it out and I only had one email address come back to me as on deliverable, and I figured it out and resent it. So to my knowledge, on my end, it looks like all of you received it. So if for some reason you didn't, please check your spam. And once you check your spam, if you still don't have it, just reach out to me, because obviously I don't have the right the right contact information from you. I remember you guys, what do we say, till next week? So like next end of the day on Tuesday, something like that. So that would be a good time for you guys this weekend. And chat, please don't chat. I'm not gonna see in the chat. So if you will actually send me an email, and then that way I can respond to your email, because like I said, clearly I don't have the right information for you. So if you didn't, send me an email and I'll respond with that link. Julie, the real estate instructor at gmail.com. As far as that little exam goes, I forgot to mention, remember we're treating the midterm like a real test. And since we're treating it like a real test, with the end of class exam and your state exam, pass or fail, you're not going to see the questions that you got right or wrong. We can't let you review those test questions. However, what we have with Class Marker, we have it set up that after the exam, after you finish, you'll get an email from Class Marker, and it breaks down the different categories for you, and it'll tell you the percentage of those categories that you got right and wrong. So for example, it'll have like sales contracts and you got 5 out of 7 questions, something like that. So I can't show you the test questions. We can't go back and review those, right? We can give you those categories, but you can use that email. Once you finish, you can use that email from Class Marker to help you identify your areas of weakness. What sections do you need to spend? So if you get 100% on contracts, I'm not saying don't study contracts between now and test day, right? But maybe you want to focus, just kind of review contracts to keep it fresh until the test, and focus on the area that maybe you didn't do so well on. Does that make sense? So just look out. I guess I say all that to say, once you finish the test, just look out for an email from Class Marker with that information. Yeah, we got a lot to do this weekend, don't we? So, we've covered a lot this week, and we'll do it again next week, and we'll do it again the following week. So time's a ticking. So I hope you guys are able to keep up, and please remember, I'm always here to help answer questions, that kind of thing. Good, you got the email. How many questions on the midterm? 55. If it's just, yes, it's a midterm. So the midterm is 1 through 10. And I think there's a question or two on 21. So the midterm is only the information that we've covered so far. Yes, and 55. Okay. All right. The other quick thing, I had a quite good question come in yesterday. With the cram course, I understand it's all day, 9 to 5 on the 27th. Okay, if you can please email me. Please email me so I can respond to your email with the link. The question I got about the cram course on the 27th from 9 to 5. The question I got was, what if I can't come all day? What if I can't devote all day to it? I can just come for a few hours in the morning. Is that okay? And the answer is yes. Come as much or often as you can, right? This doesn't count for or against your attendance, because it's not required. It's not part of the schedule. This is above and beyond something that Carolina School offers to you guys. It's included in your tuition, just to help you guys better wrap your brains around this information. So if you can only come for 3 hours that morning, then just come for 3 hours. I think some is better than none. I got the question if Annie records. She does not. So what I do know is, if you guys will look, I'm in Learn Test Pass, and at the very end, there's a folder called Cram. And if you look in that Cram folder, maybe, if my laptop will cooperate. There we go. If you look in that, it's the very end in that cram folder, you will note that there's a cram class recording. That's a cram course that Dr. Bowser did March or so, earlier this year. We'll just say that, earlier this year. So while Ann won't record the 27th, you do have a recorded cram course and Learn Test Pass for you guys. If you can do both, great. If you can only do one, there it is. If you can come for 30 minutes on Saturday morning, you know, I would say some is better than none. So just do what you can on the 27th. Questions? Cram course? Okay, well, that's all the housekeeping stuff I have. So y'all just ready to get started? Yeah. Okay, let's see. I'm not going to able to 10. Okay, good. Watch the recorded. Great, perfect. It was recorded before July. Yeah, I don't think Jane goes over forms. That was the big change we had in July 1st was forms. So I don't think she goes over forms, but to your point, if the cram course goes over forms, just know that we updated our forms in July. Thank you. Okay. Of course. Send you Ann's Zoom link on the day before. I guess that's the 26th. We'll email that out. And for those of you that didn't get the midterm link from me yesterday, you're emailing me to let me know so I can respond, but then that will let me know that the email address I have for you isn't, for some reason, I don't have the right email address. So then hopefully, and I'll just, you guys, if you don't get that link for the cram course on the 26th, you'll just need to email me that evening. Please don't wait till 8:59 a.m. on Saturday morning. I may still be in bed. No, I'm just kidding. I wish I could sleep that late anymore. I guess I've reached an age in my life where I can't do that. Nope, it's a one-time link. The midterm link is a one-time link. Okay. All right. Y'all, oh no, hit the wrong button. You already put your lender's hat back on. Let's put our lender's hat back on. We're going to get back into units 14 and 15. And remember, I think a big way to help us get through this is to think like a lender, right? We're no longer trying to get our real estate license, nor are we trying to get our mortgage lender license. But to help us better understand these units, I think it helps to think like a lender. So good morning. So where we left yesterday was talking about the loan to debt ratio. And we'll talk, we're going to have a good conversation about the second bullet in just a second. But first off, let's make sure we're good with this idea of the loan to value ratio. You know, the lender uses this to ask themselves, if the value is X amount and the loan and the borrower wants, you know, 80%, 90%, however much of the value that they want. The question of the lender is, how much do they want from me, right? Bottom line, the lender cares about, what about me? How much money do you want from me? How much money am I going to make when you borrow that money? This second bullet point says that the value is the field in the bottom left of our T-bar. And the value is the sales price or the appraised value, whichever is less. So in just a second, we're going to talk about what happens if the property doesn't appraise. But I need you guys to make sure that you write down value is sales price or appraised value. How do you tell the difference? How do you know which one to use? Sometimes you have to say, what's the sales price? What's the appraised value? And choose the lesser of the two. There is no, it's always this or always that. What is value? Value is determined as the sales price or the appraised value, whichever one is less. Your problem may give you both. It may give you the sales price and the appraised value, or it just may say the value is. If it tells you what the value is, then they've already decided which one is less. But if they give you both, then you actually need to look and see which one is applicable. So let me right off the bat, let's say you have a problem that gives you a list price of, I think I used 365. So the property is, I'm sorry, not a list price, a sales price. There we go. Sales price for 365,000. It appraised for 360,000. And the borrower is requesting an 80% loan. My question to you guys is, what is the loan amount? Take just a few seconds. You got a sales price, you got an appraised value, and you have your ratio. So please tell me in a private chat what the loan amount is. You got 30 more seconds. Looking for the loan amount. And question marks. Okay, so we said we read the problem, right? What's the problem? Say it. Sales price is 365, the appraised value is 360. The ratio is 80%. The question wants to know what is the loan amount. The ratio, the percent, the rate always goes where? Always goes where? Bottom right. Do that first. Take the guesswork out of that, right? Ratio, rate, percent always goes bottom right. What I'm solving for is the loan amount, which is the number on top. So now the question is, what do I use as value? Do I use sales price or appraised value, appraised amount? And the answer is whichever one is less. So if I have a sales price of 365 or an appraised amount of 360, which one is less? The appraised value of 360,000. 360,000, my up down line means multiply. So 360,000 times 80% gives us a loan amount of $288,000. That's how much of the purchase of the value that the lender is going to bring to settlement. That's how much the lender is going to provide the borrower. It's up to the borrower to come up with the rest, right? They need to come up with the 20% difference. So let's have a conversation. What if this happens? What the heck? So, and this happens often. So you go under contract for 365. Your buyer orders their appraisal. The appraisal comes back at 360. There's $5,000 missing there, isn't there? We got 288 coming from the lender, and then we got an extra $5,000 hanging out there that we need to figure something out with. So what do? Well, quite frankly, as the buyer's agent, I'm going to go to the seller first and ask them to reduce the purchase price to 360. As the buyer's agent, that's my very first phone call. You know, the listing agent, whatever. You guys willing to drop the price? Do your head one way or the other. Does the seller have to reduce the sales price to 360? Do they have to? No, we're already contractually obligated to each other for $365,000, aren't we? So the seller, we've already shook hands. We've signed a contract. So the seller doesn't have to reduce the purchase price. All right. What if they say no? Well, maybe my buyer's got $5,000 extra laying around. They're going to have to come up with the money for somewhere, and they're not going to be able to get another loan because they're already getting a loan for $288,000. So no other lender is going to approve them for 5, nor is this lender going to approve that loan if they're trying to get another one. And by the way, they're not going to be able to get a loan from anywhere, and that includes a private source. An example of a private source might be the bank of mom and dad. They're not going to be able to borrow money from anybody. There's a difference in borrowing money and a gift. Borrowing implies what? Yeah, pay me back. Gift says, here, honey, here you go. Can mom and dad give a gift? Sure, but the lender's going to make them sign something saying it's a gift and they don't expect to be paid back. What if mom and dad lie? Well, no, that's called loan fraud, and loan fraud is really bad. So when we say they got to come up with $5,000, they got to come up with $5,000. Our other option, what if your buyer says, oh my gosh, I just don't have $5,000 extra dollars laying around? Our third option and our final option might be to get the seller to come down some on the sales price and the borrower maybe come up with a little bit of cash. Maybe we can get the seller down to 263 and we get the buyer to come up with two, right? I mean, maybe we can meet somewhere in the middle. But guys, bottom line, if the seller's unwilling to reduce the sales price and the buyer doesn't have extra cash laying around, we got to terminate. We're not going to get loan approval. We want to make sure as much as possible in our due diligence period that we have enough time to get the appraisal ordered and get it back. Because if we have to nobody wants to terminate. Let's just be honest here. Nobody wants to terminate. But if we have to terminate, as a buyer's agent, the best I can do is terminate my buyer within due diligence so I can get their earnest money back. That's the best thing I can do for my buyers, get their earnest money back. If we find out after due diligence that it appraises for less and the buyer doesn't have money laying around, we find out after due diligence and the buyer has to terminate, they lose their earnest money and their due diligence fee. The appraisal is something that the lender orders. As a matter of fact, and John, I may be getting ready to answer your question right now. As a matter of fact, the appraisal is actually the property of the lender. The appraisal is the lender's because they're using, now the buyer gets to pay for it, but the lender's using that appraisal to determine how much they're going to give, how much loan they're going to give. So the appraisal is the lender. So the question comes in, could you get a second appraisal? The buyer could, and they could pay for it, but there's no guarantee that the lender will use that second appraisal. You're going to have a pretty compelling case in order for the lender to consider a second appraisal. If you have two that are way off, maybe you do, and the second one comes back at, 370. I don't know. I don't know what the lender's going to say. I'm going to have to say that goes down to the lender policy. But the appraisal is the property of the lender. If the buyer's getting a loan, an appraisal is required, period, end of story. Because the lender wants to know what's my interest. And they're not going to typically loan money more than what the value is considered. So I didn't say you couldn't get a second appraisal. It's up to the lender.
Julie,
You're not satisfied
so
with your lender. Yes, ma'am.
are you saying that the loan amount that the bank will give you, even though it was praised at 360, they're only going to give you 288?
It was appraised at 3. That's right, because you're asking for 80% of the value.
Okay.
You're asking for 80%.
Okay.
100% financing is awfully rare these days post housing market crash. 100% financing, you may still see that in a VA loan. And you may get, 95% in FHA, 95% conventional. Guys, let's consider this. The higher the loan to value ratio, the more risky you are to the lender. The higher the loan to value ratio, the more risky you are to the lender. If, let's see, purchase price is $365, loan amount is $288. So the buyer of this $288, the loan amount's $288, the buyer's only gonna bring $77,000, right? If it's 100%, that means in this case, the lender's gonna provide 360 because value is whichever's less. To the lender, which one is more risky? Which one is more risky? The lender giving you 288,000 or giving you 360,000? Through the eyes of the lender, which one is more risky? The 360, right? So the higher the loan to value ratio, the less money the borrower puts into it, and the more risky you are. What if you're only asking for 50%? So now you got an appraised value of 360. Now you're only asking for $180,000. Which one is less risky to the lender? Them giving you 288 or them giving you 180? Do we see? Does this make sense? The higher the loan to value ratio, the less risky you are to the lender. And the lender will issue their loan on what is determined as value, the sales price or the appraised amount, whichever is less. Questions on the loan to value ratio? Do they consider profit margin? I don't know the answer to that. Okay. In North Carolina, excuse me, we have something called usury laws. Lenders are allowed to set their own rates. Lenders can charge whatever they want, interest rates, loan origination fees. We're getting ready to talk more about that. So lenders can set their own rates. Usury laws put ceilings on what the lender can charge. This helps keep these charges and fees under control. So while they're free to charge whatever they want, usury laws come in and put ceilings on. They put regulations on the lender and says, you can't charge more than this. You can't have an interest rate higher than that. Obviously, because interest rates change every single day. Interest rates change every single day. So these usury laws need to be pretty flexible, of course. When you guys are working with buyers, it is highly recommended that you encourage and suggest your buyer to talk to 2 or 3 lenders before they decide which one to use. They need something to compare. They need something to do a side-by-side comparison. So when your buyer calls you and says, I want to buy a house, and your first question is, well, are you working with an agent? Let's get past that. And then once you do your disclosure and now you say, have you talked to a lender? And if they say, no, I don't know any lenders, who should I talk to? Never look at a buyer and say, this is the lender you're going to use. It's not your loan. It's not your 30-year commitment, is it? So when your buyer looks at you and says, I don't know any lenders, who should I talk to? You say, here's a list of 2 or 3 lenders that I've had good experience with in the past. You can recommend you talk to one of them. If you're new and you don't know any lenders yet, there's a really good chance that your firm will have a preferred vendor list. So you can kind of use your firm's preferred vendor list until you start making your own connections, forming those relationships. You'll form relationships with lenders. It's pretty valuable to have a lender on speed dial. I'm not going to lie, quick question. So you'll form relationships and then you'll be able to recommend 2 or 3. Shake your head, yes or no. Let's say I give my buyer a list of 3 lenders. Do they have to use those lenders, any of those lenders that I give them? If they say, well, here's your 3, but I like, well, then you use whoever you want to. My point, you guys, is when your buyer says, who should I use as a lender? Don't go to Google. They can do that. Why'd they hire you, right? So this is why we have relationships. This is why we form relationships. And again, if you're new, it's okay. Your firm and agents in your office have already established relationships. So just make sure you're encouraging your buyer to shop around so they can get, you know, it's a lot of things: loan amount, interest rate, monthly payment. You know, they got to shop around and have something to compare so they can get the loan that they're the most comfortable with. Lenders sometimes charge borrowers, and sometimes borrowers ask to pay for something called discount points. Discount points are prepaid interest. Discount points are prepaid interest. Discount points are only prepaid interest. If you're buying discount points, if the lender is buying discount points at settlement, they're going to prepay some of their interest to the lender. Prepaid interest. They're paying it at settlement. Why might a lender ask, or why might a borrower request? In exchange for prepaying interest, it increases the lender's yield. Now, we're not going to get bogged down on this. All we need to know about the lender's yield, the lender's yield is their return or profit on a loan. In the eyes of the lender, the higher the yield, the more sellable it is to the secondary market. And we will talk about the secondary market in Unit 15. So for the lender, they may request the buyer to pay interest, prepaid interest at settlement, because for the lender, it could increase their yield. It increases their return. And the higher yield makes for a more sellable loan. What does the buyer get? You're telling me the buyer's going to bring extra money to settlement. Julie, what do they get? Well, they get to decrease their interest rate. They're buying down their interest rate because they're prepaying their interest. So by decreasing their interest rate, they're going to have lower monthly payments. Do lenders offer kickbacks to firms for bringing them clients? They can't. There's a law that says that they cannot, and we will talk about that soon. So hang on to that question for just a minute. So with discount point math, there's 2 different things to consider. The first thing to consider is how much the buyer is going to have to bring to settlement. What's their charge going to be at settlement? Discount point math, your problem will tell you the buyer is buying 1 discount point or 2 discount points or 4 discount points. 1 discount point is equal to 1% of the loan amount. What's the word of mean in a word problem? What's the word of mean? Multiply. So if you're buying 1 discount point, what's your charge going to be at settlement? You take the loan amount times 1. And that's how much prepaid interest you're paying at settlement. 2 discount points is going to be equal to 2% of the loan amount. 3 discount points is going to be equal to, anybody want to guess? 3% of the loan amount. You guys see how we're doing here? The problem will tell you the number of discount points, and the number of discount points will tell you the percentage of the loan amount. So that's one piece of it. And we will see this again in Unit 21 when we figure out how much the buyer has to bring to closing. We're going to have to calculate their discount points. This is a charge. This will be a debit to the buyer at settlement. The second piece of math, and I need everybody to listen to me very, let me see. I got a question. Higher yield decreases interest rate. No, discount points increase the yield. Discount points decrease interest rate. So don't lump those, put the lender here and the borrower over here, right? Keep those separate. Okay. So this is one piece of math. What's the amount that the borrower has to bring to settlement? And we will see this again in 21. The second piece of the math that you may see, could I stress that anymore? You may see it. The second piece of the math is going to say, what is the borrower's new interest rate or the lender's new yield? Now, this is what I need to make sure everybody hear me say. You don't need to worry about changing the interest rate in a problem unless you are specifically asked to. If they give you a problem and they say their interest rate is 4.5%, then you roll with that 4.5%, unless it says what is their new interest rate. Okay. Don't worry about this next piece unless you're specifically asked. And it's this next piece that I say you may see on the test. First piece you will see 1 point equals 1% of the loan. 1 point when we're talking about the purchase, or I'm sorry, the interest rate, 1 point is equal to 1/8%. When we do discount point math, I like to think about pie. Do you guys like pie? What's your favorite pie? No, don't. That's just going to make us hungry. It's awfully early to talk about pie. Discount point pie is 8 pieces. Discount point pie is 8 pieces. So if you are buying 1 discount point, if you're the borrower and you're buying 1 discount point, then you're buying 1 piece of pie. If you're buying 2 discount points, it's 2 pieces of pie. 3 discount points, da, da, da. So 1 point is equal to 1 piece of pie, 1/8. You guys know I'm a fan of math. Yes, I like my math. What I don't like about math is fractions. I hate fractions, and I hate the word hate, but dang it, I hate fractions. And when I see a fraction, the first thing my mind says to do is to convert it to a decimal. Because once I convert it to a decimal, now I have a number that I can work with. So if I see 1/8, 1 piece of pie, first thing I'm going to do is convert that to a decimal. So on my calculator, I take 1 divided by 8, and I get a decimal of 0.125. Now in my mind, I have a number I can work with. I hate fractions. So 1 point is equal to 1 piece of pie. 1 piece of pie is 0.125. Let's say, for example, your buyer was quoted an interest rate of 3%. And they say, is there any way I can make that interest rate lower? Is there anything I can do to get that interest rate below 3%? The lender's going to respond and say, you can buy discount points. You can prepay interest at settlement. And by prepaying interest at settlement, that will buy down your interest rate. So this borrower was quoted 3%. They say, is there anything I can do to get this lower? They and the lender have a conversation, and the buyer decides to buy 1 piece of pie, 1 point. It was 3%. Now we're going to deduct. And now their new interest rate is going to be 2.875%. They bought down their interest rate by 1 piece of pie. How would that look on the lender's end? They're going to increase their yield. So now where we did have a 3% interest rate, the buyer bought a discount point, bought down their interest rate by prepaying interest, by bringing money to settlement. Their new interest rate is going to be 2.875 for the life of the loan for the next 30 years. Their interest rate is going to be 2.875. And then the lender's new yield is going to be 3.125. Again, the buyer can request, the lender can suggest. What's in it for the buyer? They get a lower interest rate. Lower interest rate means a lower monthly payment for the next 30 years. Again, you guys, Don't worry about the interest rate unless the problem specifically says, what is the new interest rate? Did everybody hear what I just said? Don't worry about it unless the problem says, what is the borrower's new interest rate? What is the lender's new yield? How does the lender's yield increase? Because they're getting that money at settlement. The buyer's bringing extra money for prepaid interest, and that prepaid interest goes directly into the lender's yield, the lender's fund, to make for that higher increase, that higher sellable loan. Yes, the buyer's paying less monthly, but they're bringing more money to settlement. They're bringing more money to put in the lender's pocket at settlement. The lender will get their money. Either they're going to collect some of it up front, or they're going to collect it on the monthly payment. Why would you go through discount point? You don't have to. You don't have to. But maybe the idea of, so now you lower your interest rate, which means you lower your payment. Let's just say, again, I'm just kind of making stuff up. Let's just say you were quoted with a monthly payment of $600. You buy a discount point and now it lowers your interest rate to $585. If you keep paying that $600, you're still going to pay it off faster, right? So maybe by having that lower interest rate, now you've got what, $15 extra a month that you're putting on your principal. So you may still pay that off faster. So that might be a strategy for the buyer. You have the lower payment, but you're still paying what you originally quoted. Remember, we said principal reduces the balance. So the more of the principal you can pay, the faster you pay it off. 1 point, how much the buyer has to bring to settlement, you will see that on your test. We will see that in Unit 21. Do not worry about the new interest rate or the new yield unless you are asked. Everybody good? So can we figure out what the whole amount would be over the life of the loan, 30 years? Absolutely. We gave you those formulas yesterday. Yep. So you could figure out with the old interest rate, interest over the life of the loan, and then you could figure out the new interest rate, interest over the life of the loan. I gave you those tools yesterday, interest over the life of the loan. All right. Here is something for you guys to consider. I'm going to give you a couple minutes because I really want you guys to take time and consider this. You get the purchase price, you get the information about the loan amount and the interest rate, buyer's purchasing 2 discount points. I want to know in a private chat how much in discount points the buyer will pay at closing. I want to know the borrower's new interest rate and the lender's new yield. Please make sure you consider this problem. The loan amount, is it going to be on the purchase price? Or is it going to be on the, the loan amount is going to be on the purchase price, but our discount points going to be on the purchase price or on the loan amount? So what I'm trying to tell you is first we need to find the loan amount so then we can find out how much in discount points. Tell me in a private chat when you get it, and then of course we'll talk about it. And I apologize. When we ask how much the buyer's paying in discount points, I'm asking how much they're bringing to settlement. How much are they bringing to settlement for those discount points? We've got one more minute and then we'll talk about it. Okay. So let's see, we got a purchase price of 265. The buyer's obtaining 80% conventional loan at a 4.5% interest rate. Buyer's purchasing due discount points. The first thing we want to know is how much in discount points will the buyer pay? We want to know how much is the buyer bringing to closing. Discount points are calculated off of the loan amount. So the first thing I need to do is determine what the loan amount is. My loan to value ratio, we've told the purchase price, in this case, the value, they're getting 80%. So to find my loan, I take 80% times $265,000, and we get a loan amount of $212,000. So step one is to find the loan amount. If they are buying 2 discount points are a percentage of the loan amount. So if they're buying 2 discount points, we now know the loan amount is $212,000, and they're going to purchase, of means multiply. So they're going to purchase 2%. So $212,000 times 2% means $4,240. How much extra will they bring to closing? $4,240. If I could just stop here real quick and say something while I'm thinking about it. Anytime you're dealing with lender charges, discount point, interim interest, loan origination fee, all that we're getting ready to talk about. Anytime you're dealing with lender charges, it's always going to be of the loan amount. Because what does the lender care about? What does the lender care about? The loan amount. That's their money, right? So anytime you have lender fees, thank you, they're always going to be of the loan amount. So we have $4,240. We know they're going to bring to closing. I'm just going to rewrite that. I'm going to put that like over here so I can give myself some more room. So how much will they have to bring to closing? $4,240. What questions do I have about that? When we calculate how much does the buyer have to bring to closing, this will be a debit to the buyer. We'll see this again in 21. We'll get to do unit 21 on Tuesday. Questions so far? Okay. Can I erase the rest of this so I can give myself some room? I'll keep the 4240 so we see that, but can I erase the T-bar and the math and everything, how I got to the 4240? Speak now. Is that added to the dish? Yes, that's part of their debits. Buyers have a slew of debits, and discount points could be one debit. The next question wants to know 2% is 2 discount points. 2 discount points is equal to 2% of the loan. 3.5 discount points is equal to 3.5% of the loan. The number of discount points, there's your formula. The number of discount points tells you the percentage of the loan. Okay. Next question wants to know what the borrower's new interest rate, what the borrower's new interest rate. So here we could think about discount point pi. Discount point pi is always 8 pieces. Why 8 pieces? Because one discount point is equal to 1/8. So if one discount point is equal to 1 piece of pi, then 2 discount points is equal to 2 pieces of pie. Everybody with me so far? 2 discount points is equal to 2 pieces of pie. 2 pieces of pie is 2/8 or 0.25. We hate fractions. So we take 2 divided by 8 and I get 0.25. The buyer's interest rate was 4.5%. They prepaid 2 discount points. So as a thank you, if you will, for prepaying discount points, we're going to deduct from their interest rate 2.5. So now their new interest rate going forward for the life of their loan is 4.25%. What's the buyer's new interest rate? 4.25%. Will it always be an 1/8? Yes, because 1 point is equal to 1/8. 2 points is equal to 2/8. 3 points is equal to 3/8. 4 points is equal to 4/8. If you want, that's right. If you want to reduce by 1%, you got to buy by a whole pie, don't you? If you want to reduce it by 1%, you got to prepay. Y'all don't worry about the lender. The lender will get their money. They're either going to collect it from you at settlement or monthly for the next 30 years, right? They will until you pay it off. Don't you worry about the money. They'll get lent. So the limit you could pay, you could buy more than 1 pie. That's getting a little out of our realm. So yeah, what if you want more? You could buy more than 1 pie. For our purposes, you may see a practice problem that has more than that, but I wouldn't get bogged down that. So on your calculator, we take 4.5 minus 0.25. So I take 4.5 or 4.50 minus 0.25, and now we have 4.25. So what's their new interest rate going to be? 4.25%. And then the final question here is, what is the lender's yield? Again, we're all going to start at the same place. Lender's starting with 4.5%, but since the lender's yield is going to increase, instead of deducting, now we're going to add. So what's the lender's new yield? They now have a more, and all we need to know about the lender's yield is that the higher the yield, the higher their yield, the more sellable it is. So while they did have a yield of 4.5%, because the borrower brought them money, actually at settlement, gave them money, now they have a higher yield of 4.75%. I hate that you hate math, by the way. Don't hate it, just practice. Just practice. Everybody promise me you're going to practice? Everybody shake your head, yes. I could make you pinky swear if we were in person, but we're not, so I can't. Virtual pinky swear. Yes, Julie. Practice, practice, practice. Discount point. Again, you guys, big picture. All a discount point is prepaid interest. The buyer's bringing extra money to closing. Why? To buy down their interest rate. Why? To have a lower monthly payment. Do not worry about adjusting interest rates or yields or pie unless you're specifically asked, what is the borrower's new interest rate? The yield, that's the lender's yield. The higher the yield, the more sellable it is. As we talked the other day or yesterday, I guess, lenders often sell their loans, but they have to have a sellable product, right? Lenders have people out there buying loans from all the lenders. So how do they make theirs stand out? How do they make theirs more sellable? How do they get a better chance of getting theirs sold? They have a higher yield. So how we have a higher yield, it would be to increase their yield. Since the buyer's buying 2 pieces of pie, we can increase their yield by 0.25. 2 divided by 8, 2 pieces of pie is a quarter. So we're going to add 4.5. Gives the lender yield of 4.75%. Do I just add the discount points to what? practice this weekend. You got discount point practice in 14 and 15 math. Again, we're going to see this again in 21. So that's the good news. We'll get to see it in practice when we get to unit 21 next week. The last piece of math in unit 14 is something called a loan origination fee. The lender charges the borrower a fee to originate the loan. It costs them money to process it. They got to have administrative do work. They got to crunch the numbers. They got to send it to underwriting to approve. We'll talk about underwriting in the next unit. It takes them money to process the loan. So how do they recruit those fees to process it? They charge a loan origination fee. They charge you to originate, to start your loan. The loan origination fee, it's of the loan amount because it's a lender charge. Loan origination fee is the loan amount, and then they actually have to tell you what the loan origination fee is. They will say the loan origination fee is, for example, 1%. There's no across the board, there's no formula. They're actually going to tell you what the loan origination fee is. So you guys just take a minute. Again, I got a purchase price. The buyer's getting an 80% loan. The origination fee is going to be of the loan amount. So first find the loan amount. And then in a chat, tell me what the loan origination fee is. Lenders can charge whatever percentage loan origination fee they want, as long as it stays under usury laws. So as long as their loan origination fee doesn't go above usury laws. They're all different. All lenders are different, which is another good reason to have your borrower shop around. Okay, give you about 30 more seconds. All right, so we got a purchase price of $265. We got a 1% loan origination fee. Buyers obtaining an 80% conventional loan. Loan origination fee is of the loan amount. So first off, we need to find that loan amount. So we got a ratio, loan to value ratio, 80%. I'm looking for the loan amount, and my purchase price is $265. So my loan amount is $212,000. Everybody good so far? We got a loan amount. Kind of piggybacked off the last problem. So we got a loan amount. Loan origination fee is of the loan amount. In this case, it tells us they're going to charge 1% loan origination fee. So in addition to discount points, the buyer's also going to have to bring $2,120. Buyer has numerous debits that all add up for how much do they have to bring to closing. It's not just their down payment. They have other fees and charges, and those other fees and charges include lender charges, and that's all what we're going to discuss in Unit 21. So we first found the loan amount. What questions do I have? We found the loan amount. Problem tells me 1%. So we're going to have a debit to the borrower, $2,120. Um, I mean, I hear you. It's not cheap to buy a house, right? Um, consider this. If you have a roof over your head, you're paying somebody's mortgage. If it's not yours, it's somebody else's, isn't it? If you're not paying your own bills, you're paying somebody else's. So one way or another, if they want to originate the loan, they're not going to have a choice, because if they have to get, that's right, if they're a cash buyer, they're not originating a loan. But if they're going through a lender, then they have to originate the loan, and the lender's going to charge them because the lender's got to, you know. So the only way you could avoid the loan origination fee is if you got cash. You're going to live with your parents for the rest of your life. They may start charging you rent too. You never know. Mine sure as heck would. The day they dropped me off at college, they never looked back, y'all. They let me come home for Christmas. Again, loan origination fees are part of discount points. I'm sorry, are in addition to, let me say that again. Loan origination fee is in addition to discount points. Loan origination fee is mandatory. If you're getting a loan, you're going to have to pay the lender to originate the loan. Discount points may or may not be optional. It may be a discussion between you and your lender. We'll see loan origination fee again in Unit 21 too. So we'll see these again when we figure out how much the buyer has to bring to closing. Okay, let's take a break. When we come back, we're going to wrap up Unit 14. Ooh. We're back. I can't answer that off the top of my head. Just stick with me. All right. Cameras are on and I can see you. A couple more things in Unit 14. We're done with the math for 14. But we do got some more math when we get to 15, so we'll see that in just a second. Just a few more things in 14, talking about, thank you for letting me know that you're back. Last piece to talk about in 14 is just some different loan repayment plans. There are several different ways that borrowers could pay the lender back. What we've been talking about so far is this fixed rate level plan. When I say rate, we're referring to the interest rate. So when we say it's a fixed rate, once you get your rate locked, the lender says, this is your rate lock. This is what your interest rate is locked in at. And that's your interest rate for the entire life of the loan. Obviously, if you buy discount points, that kind of thing. So that's what we've been talking about so far. The interest rate is locked in. Another, and that's the most common, by the way. That's why that yellow star is there. Another loan repayment plan, there's an interest-only loan, which means the borrower is only making payments on the interest. Their monthly payment is interest only. Once they make that last interest payment, they will have to pay the principal in one lump sum. That's called a balloon payment. Once you pay the loan off, if there's anything left, that whatever's left is referred to as the balloon payment. An example of who might use an interest-only loan, maybe a developer, for example. They use an interest-only loan to purchase the land, and then they build on the land and sell the properties. So while they're paying off the land, they would only pay interest. Once they pay that interest off, then they would pay that principal. And then, you know, have money, because now hopefully that by now they've sold a home or two, right? So they have that to pay that off. These are usually short-term loans. Think like 3 to 5 years. Another loan repayment plan is an ARM. You guys may have heard of an ARM, an adjustable rate mortgage. With an ARM, the interest rate adjusts. So with an ARM, the interest rate adjusts. You could originate it at one level and it could fluctuate up and down throughout the period of the loan. Maybe it's predetermined when that interest rate is going to fluctuate. Maybe it's not. There's a picture on page 379. You see this person originated at 6.9%. And then the interest rate adjusts up and down throughout the period of the loan. With an ARM at first, you may have a negative amortization. Remember yesterday we amortized, we did our 3 steps in amortize, and the third step said the principal reduces the balance. If you have an ARM, like for example, this 9%, instead of deducting from the balance, you may be adding to the balance, negative amortization. So you may have some periods where you add to the balance and then eventually pay that off. We also have a graduated payment mortgage. another loan repayment plan. Graduated payment mortgage, payments are lower at first and then increase as time goes on. They graduate. They're lower at first and then they increase as time goes on. Again, this may result in negative amortization at first. You may be adding to your balance at first. An example of who might use a graduated payment mortgage, I think of like a startup company. I just started a business. I just started my brand new business and I'm not making any money yet. But the expectation is that next year I'm going to start making money. Year 2, I'm going to even making more money. Year 3, even 4. So the expectation is hopefully as my business grows, I can start paying down some of that mortgage. We've mentioned a balloon payment. This is when your final payment, there's still a balance due. That balance due will be in one lump sum. That balance due is referred to as a balloon payment. And then a growing equity mortgage. Growing equity, first off, equity is what you have invested in your property, what you have invested. And we'll talk about equity in chapter 18 and 18, I think. But a growing equity mortgage, your interest rates are fixed. You have a locked in interest rate, but your principal payments increase or decrease. And they usually use some kind of like government index, maybe, for example, the government's cost of living. So your interest rate is the same, you're paying the same interest rate, your interest payment is the same, but your principal can adjust up or down as, for example, the cost of living. Cost of living goes up, principal goes up. Cost of living goes down, principal goes down. So growing equity, your interest rate is fixed, but your principal payments adjust accordingly. Again, we'll talk about equity in unit 18 or 12. I don't remember. We'll talk about it. Again, you guys, I'm going to go back just for 1 second. These are all green stars except this one, because this is the one that we do the math one, the one that we use the most. And always remember, even though we temporarily have a lender hat on, always remember we are not lenders. Unless you're a mortgage lender, I really can't advise. I mean, in my experience, when I'm working with buyers, if they have a lot of questions about their loan, I'm directing them to the lender. I'm encouraging them to reach out to their lender. We just go through these units to give us a very basic understanding of how this stuff works. And that gets us through unit 14. So the key terms, back on page 363. That key point review, your Cliff's Notes, if you will. 383 to 384. And then your student quiz, which does have some good math practice, 385 to 387. If you guys will please turn to page 387 with me real quick. I want to point something out on page 387. 387. You guys see those last 3 problems, 28, 29, and 30? Those problems all build off of each other. They give you a little bit of information, then all 3 of those build off of each other. You can't answer those yet. You're still missing a piece to answer those. We will cover that piece in unit 15. So, and we'll get through 15 today, no problem. So I just let you know that when you're doing these problems in 14, there's math from 15 that you need. I don't know why it's here or not there, but I just wanted to point that out. And then you got your math practice, math concepts. There's a little bit more math in unit 14 than what you need to know, than what we went over. So just focus on what we went over. Don't create more work for yourself. There's those 50 problems in the back of the book. These are the numbers that relate to the math that we just did in 14. And then I got some math worksheets for units 14 and 15. I combined the financing, but there's some extra practice for 14 and 15 in Learn, Test, Pass. So while unit 14 was our financing, keep your lender hat on. And while 14 was your financing, 15 is 15 is more about practices. So we're going to get into just some more practices on how financing works. But continuing on our financing discussion, in 15, we're going to define, we're actually going to talk about conventional loans, FHA loans, VA loans, a couple other types of loans. These three are the most common, the ones that you'll probably be working with the most often. We're going to talk a little bit more about that secondary mortgage market. That secondary mortgage market is who your lender sells your loan to. So we're going to talk more about that secondary mortgage market and why they sell your loan. We're going to explain the practices and procedures for lending. And then we got some math. We're going to learn how we can calculate that monthly principal and interest. And then I'm going to show you guys how you can qualify your buyer. If they need to see a house right now and you can't get a lender, you could actually try to do a quick qualification on your buyer and see if it's worth your time and theirs. Make sure they can afford it. So let's first start with kind of an introduction to the real estate financing market. I've mentioned the housing market crash before. The housing market crash was bad. It was a tough time in real estate. This is about 2008, 2009, 2010, that era. There are a cajillion theories out there about what went wrong that caused the housing market crash. And one of the more common theories is fraudulent lending practices. So as a result of that, some things have been created to help better protect the consumer. Particularly, we now have the Consumer Financial Protection Bureau. Its whole job is to protect the consumer. And it's important that we understand when I'm talking about a buyer originating a loan, the consumer in this transaction, the buyer's buying the seller's home, the consumer in this transaction is the buyer because they are the borrower. They're the ones originating the loan. The seller may or may not already have a loan. They're protected by their loan. Consumer Financial Protection Bureau is protecting the buyer because they're the ones originating a loan. And another thing we got from the housing market crash was something called TRID. And we're getting ready to define TRID on the next slide, so bear with me. Thank you. TRID's not that old, is it? We just got TRID. What are we coming up on? TRID's getting ready to turn 7. So TRID's not that old. Again, this was a big result. It used to be, prior to the housing market crash, it was really easy to get a loan. I mean, really easy to get a loan. Some lenders were relying on the information provided to them by the borrower. So they would call the borrower and say, how much do you make a month? And they would spit a number out. And then they would ask the borrower, what's your monthly debt? And they would spit a number out. And the lender never verified it. They just relied on the information provided to them. The result of practices like that is foreclosures, short sales, housing recessions, that kind of thing. So again, hopefully these practices have been put in place. These lender laws have been put in place. And it's important that we understand that TRID, again, I'm going to define it. TRID is a lender law. This is not a broker law, but it's a lender law. However, we're working with lenders and buyers on a regular basis. So we need to have a general understanding of how TRID works. All right, what the heck is TRID? Man, we love our acronyms in real estate, don't we? TRID is the acronymness of all acronyms. TRID stands for the TILA-RESPA Integrated Disclosure. TILA is an acronym for the Truth in Lending Act. RESPA is an acronym for the Real Estate Settlement Procedures Act. What TRID did is combine the two. It integrated the two. TILA was always around, RESPA was always around. A lot of their practices were similar. A lot of their forms looked alike. And consumers were confused because they thought they were signing the same thing twice. I already signed this. So one big thing that TRID did is try to simplify it for the consumer. We're going to talk a little bit about TILA in this unit. We'll talk about RESPA in unit 21. They both still do a couple different things. Again, they've always been around. So they do both still have a few things that we need to be aware with. So we'll see this today, and then we'll see this again in 21. When you guys see TILA, truth in lending, I want you to see lending. TILA tells the consumer, it discloses to the consumer how much is it going to cost you to obtain this loan. TILA tells the consumer the cost to get the loan. It's the Lending Act. When you see RESPA, I want you to see settlement. RESPA tells the consumer the cost to close. TILA discloses the cost to obtain the loan. RESPA tells the consumer the cost to close. The two together created TRID. So let's talk about the players in the lending field. Who are the players? At the top of the tier, we have the Federal Reserve System, or the Feds. The Fed's role is to maintain money supply in the economy. And too much money in the economy, they need to pull back. Not enough money in the economy, they need to invest some more. The Feds help regulate the money to keep our economy going. So their role is to regulate the supply of money, possibly interest rates, help keep sound and favorable economic clients, economic conditions. They may have some reserve requirements, how much lenders are allowed to keep in reserve. Most banks have money in reserve that they're not allowed to spend. They're not allowed to loan. They have to keep money in reserves. How much they have to keep is regulated by the Feds. And the Feds can also provide funds for our lenders, for our banks. Guys, our lenders don't have this secret pool of money somewhere. Our lenders have to get their money from somewhere. If you apply for a loan for $100,000, the lender has to get that $100,000 somewhere. They don't have a money tree out back that they can just go pluck a $100,000 bill and say, here you go. So the Feds may provide money for the lenders so they can in turn give it to us. Again, the Feds are the top tier. They're the ones that regulate. And this isn't just about real estate, by the way, is it? We're talking about the whole economy. Real estate's just part of the economy. The next tier under the Feds, we have the primary mortgage market. The primary mortgage market is who you and I go to originate a loan from. When you want money and you go to a bank or a lending institution, where you're going is the primary mortgage market. They're the ones that originate our loans. They make their money either by borrowing it from the Feds or by charging us loan origination fees, interest payments. We said that the lender may or may not service your loan. If they service your loan, it means that they may or may not sell it. Some lenders do service it. Some lenders keep it in-house. Up to the lenders, they're all different, just like real estate agents and firms. We're all different, so are the lenders. If your lender services your loan, if they sell your loan, they are selling your loan to a player on the secondary mortgage market. The main role of the secondary mortgage market is to purchase and service loans from the primary mortgage market. So let's talk about why they do this. Several times in my career after closing, it might even be like, I think there was once, it was like a week after closing. My buyer called me and said, Julie, we've had this loan for a week and I just got a letter from my lender saying that they've already sold my loan. I haven't even had it for a week and they've already sold it. And then she was kind of cute. She's like, I thought my lender liked me. Your lender loves you. Let's make no mistake about this. But your lender, once again, doesn't have this endless supply of money. Let's say the lender has this much money to lend out. They got a pool of money and they have this much money to lend out. And they give money to you, you, and you. Once they give you all their money, they have no more money to lend out, right? So how can they replenish their funds? Sell your loans, fill their pool, and now they can originate money to you, you, and you. By your lender servicing or selling your loan, it helps keep money flowing in the economy. Once the lender has no more money to lend, they're out. So they have two choices. If they service in-house, they're collecting interest rate from you over the next 30 years. Or they can sell your loan, replenish their funds, so they have more money to issue new. It just helps keep the money flowing in the economy. There are some players in the secondary mortgage market, one of whom I'm pretty sure you've heard of. Y'all ever heard of Fannie Mae? Fannie Mae is a player in the secondary market. Fannie Mae is the biggest, the oldest. Fannie is the hungriest. Fannie will buy them all. She doesn't care. Fannie says, just give me a loan. Conventional FHA, VA, I don't care. Fannie will buy them all. She's the one that's been around the longest. Fairly new to the game is Ginnie Mae. Ginnie's a little pickier. Ginnie's only going to buy FHA and VA loans. Ginnie's not going to buy conventional loans. One thing we're going to learn in just a minute, VA and FHA loans are government-backed loans, which means they're backed by the government. We'll talk more about that in just a second. One way I remember Ginnie is because government starts with G, Ginnie starts with G. What loans does Ginnie buy? GG. Ginnie buys the government loans. What are the government loans? FHA and VA. If it's not a government-backed loan, Ginnie's not going to touch it. Another fairly new player to the game is Freddie, and he's really picky. Freddie's only going to buy conventional loans. Freddie's not going to buy government-backed loans. Freddie's only going to buy conventional. We're going to talk about conventional, FHA, and VA starting on the very next slide. I do want to point out, I've been talking about the housing market crash. Your book talks about it on 394 to 395. Kind of gives you a little history there. I do suggest you guys reading that because that helped form some of the laws and the rules that we have today. Please don't do it now. Please make yourself a note to do it after class if you have not already. But the housing market crash, as bad as it was, again, it did form some things that we have today. And I think the best thing that came out of it is better consumer protection. Y'all, when I used to say it was so easy to get a loan, I'm not kidding. I mean, have you ever heard the saying, if they can fog a mirror, they can get a loan? It's the way it was. It was almost like Oprah giving these things out, right? Like you get a loan, everybody gets a loan. It was kind of like that from some lenders. And TRID and the feds and everybody stepped in and said, this is not fair to the consumer. So the reason we have a lot of these protections into place now is to protect me and you. Now, I have also mentioned, remember, real estate is a market. Markets fluctuate up and down. You will have lows. There will be lows again. But hopefully, the hope is that with these new consumer protection policies in place, the lows won't be as low as it was in the housing market crash. If I can give you guys a quick example of how bad it was. back in the housing market crash. I was still an administrator. I wasn't in sales yet. And I was still an administrator. And I'd go to the office every morning. And before I ever started the coffee, and y'all know by now how I feel about my coffee, but before I ever started the coffee, I would walk the halls of the office to see what agent had come in and packed up their office and cubicle from the night before. Agents were dropping left and right. Lenders, appraisals, home inspectors, attorney, like everybody involved in the processes was feeling the effects of these. And I was walking up and down the halls to see who was gone so I could call my BIC, give him a heads up before he got there. It was bad. They reduced my hours. We had to work on reduced hours because the sales weren't there. The product wasn't there. We were telling sellers, do not sell unless you have to. This is not the time to sell. So again, I certainly don't want to imply that we're not going to have highs and lows. Real estate is a market. But the hope is that some of these practices and policies that we have in place now will prevent that low from being that low again. That low was tough. Don't these regulations make it hard for people to get loans that don't have a W-2 job? You know, I told you the other day, isn't it ironic? As a real estate agent, I may not be a good candidate for a loan. Ain't that something? Because I'm not a W-2 employee. I don't have consistent income, right? If you get paid every 2 weeks, you look more favorable to the lender than you do, for example, the real estate commission agent that, you know, so how does the lender combat that? They may request further payment history. Like they may say, okay, for somebody with a consistent income, I want to see 2 years of income, but because you don't have consistent income, I want to see 4. So they can still, I'm not saying real estate agents don't get a loan. I'm not saying 1099 employees don't get loans. I'm saying they may just have to work a little harder. So starting on page 396, let's talk about the more common loan types. We're not going through all of them. Again, we're not in lender school. Conventional loans are not backed by a government agency. What I made by that is the government does not offer a safety net to the lender. The lender would need a safety net in the event of the borrower's default. If the buyer stops making payments, the lender needs somewhere to fall. And conventional loans are not backed by the government, which means the government doesn't provide the safety net for the lender in the event of the borrower's default. If the borrower defaults, the lender bears all the risk. How the lender can protect themselves, and we'll come back to conforming in just a second, but how the lender can protect themselves is by charging PMI, private mortgage insurance, when the loan to value ratio is 80% or higher. If your loan to value ratio on a conventional loan is 80% or higher, added on to your monthly payment will be private mortgage insurance. That's what the lender has for protection. They're collecting, they're collecting money in the event of your default. Once you get your loan paid down to under 80%, then they should drop your PMI because you're not as risky. Remember, the higher the loan to value ratio, the more risky you are to the lender. So once you get that down under 80%, that PMI should drop. And I say should, they may have a set date for it to drop if they're following their amortization schedule. But if you're paying it off sooner, you're going to drop below 80% before their set date. So it may not be a bad idea to call your lender and say, hey, I'm under this 80%. Can we go ahead and drop that? Conventional versus conforming versus non-conforming loans. Conforming loans meet certain bank requirements. Conforming loans are sellable on the secondary market. Non-conforming loans then don't meet those bank requirements, and we don't need to worry about what those requirements are. Non-conforming loans are not sellable. They don't have those certain requirements. So conventional loans could be conforming or non-conforming. Why don't you guys tell me in a chat, private chat, of the players on the secondary market, who will buy conventional loans? Of the players on the secondary market, who will buy conventional loans? So who will buy conventional loans? I always say Fannie. Fannie's the oldest, Fannie's the hungriest. There's not much out there Fannie won't buy. In addition to Fannie, Freddie may also purchase secondary. I'm sorry, conventional. Freddie may also purchase conventional. Yeah, we're old pals and I, Fannie and I, right? We go way back. So conventional loans. So let's talk just a little bit more about this loan to value ratio, PMI, that kind of thing. Let's say the home appraised for $100,000. The loan amount is $90,000. That means the borrower is paying 10%. The borrower is bringing $10,000. Our loan to value ratio says 90,000 divided by 100,000 means that the lender's loan to value ratio is 90%. 90% is more than 80, yes? So this conventional loan of 90%, the borrower is going to bring their little $10,000, but to protect the lender's interest, they're going to charge private mortgage insurance because their loan to value ratio is above 80%. Once you get it under 80%, that PMI should drop. You're not as risky to the lender once you get it under 80%. Remember, what does the lender care about? In the event of the borrower's default, can I sell the house and get my money back? So if you originate a loan for 90%, this means that the borrower has to sell the home for $90,000, or the lender, plus the cost of the sale, plus any unpaid government fees. Remember, the lender is third in line in a foreclosure. So in addition to the $90,000 owed to the lender, we got to pay the trustee and we got to pay any unpaid government. The more you get that paid down, the better chance they have to get paid. And guys, I think when we think of foreclosure, we tend to think of the borrower being many years into their loan. I heard of a case once where the borrower never made their first mortgage payment. They bought a house, they took a loan, and they never made their first mortgage payment. That's what the lender has to consider. If I bring them $90,000, what if? And that's why as you pay that off, you become less risky to the lender. Because the lower your loan to value ratio, the more money you have into it, the less money the lender has in it. Remember, we talked earlier about 80% loan to value ratio versus 50% loan to value ratio. The higher the loan to value ratio, the less money the borrower has in it. Another loan product we have is called an FHA insured loan. FHA is backed by the government. The government is backing the lender. Specifically, the government is insuring the lender. What are they insuring the lender of? In the event of the borrower's default, the government is insuring them. They're offering them a safety net. If the borrower defaults, they can step in and help. FHA loans are operated under HUD, Housing and Urban Development, government agency. Again, FHA insures the lender. Please don't misunderstand. FHA does not provide property insurance. They don't insure the borrower. What FHA does is insure the lender. They offer the safety net for the lender in the event of the borrower's default. Loan to value ratios with FHA loans tend to be a little bit higher. Last I saw, and y'all do, you can write this down, but write it down in pencil. Don't write it down in ink, and don't worry about it because you're not going to be tested on it. But just as an example, last I saw, FHA was allowing qualified buyers to bring 3.5% to closing. If you're buying a home and you're bringing 3.5%, how much is the lender bringing? If you're buying a home and you're only bringing 3.5%, isn't the lender bringing the rest of it? That makes the lender a little nervous, doesn't it? So how does the lender protect themselves? They have the government back them. They have the government provide a safety net. Not all people will qualify for an FHA loan. There could be certain restrictions, requirements. Not all properties are going to qualify for an FHA loan. FHA appraisals are different. The lender is working a little bit harder to protect their 96.5% interest. Not allowed with manufactured home, that's right. I was under contract once and the seller was in the process. She had a guy and the seller was in the process of redoing the back porch. It was a screened in back porch, but they were repainting it and redoing the screen and everything. And the appraiser happened to go by on the day that he was working. And the appraiser made note, this house was built before 1978. So the appraiser made note that there was paint chips laying around the porch because you have to scrape paint, you know what I'm saying? So you can repaint the porch. And he made a note. We couldn't get loan approval until we proved that those paint chips had been cleared up. Because what if kids come around, right, and start, picking stuff up? Kids pick stuff up, right? So the appraisal process on an FHA is much stricter. Again, not all people are going to qualify. Not all properties are going to qualify. When you start working with buyers, I highly suggest you go, do a little bit of research. Your firm will help you, but you can get an idea of things that FHA won't approve. So, for example, it might be, paint chips laying around. If the roof is 30 years old, for example, they may not approve that loan. So you can get that information when you're working with that buyer. So you can kind of help steer a point, kind of save yourself some time and money. I'm not sure what a mod is. So FHA insured, we're insuring the government in the event of the borrower's default. FHA insured loans apply to residential 1 to 4 unit property loans. If you're getting a 5-plex or more, an apartment building, for example, you're not going to be able to get an FHA loan. FHA does require owner occupancy, which means you can't rent it out. I'm not sure about modular homes. Yeah, I'm not sure. FHA loans charge a one-time fee called a MIP. Here's another acronym for you. A MIP is a mortgage insurance premium charged on an FHA loan. It's a one-time fee charged at closing. Again, you got an FHA approved appraiser, different appraisal criteria. Remember yesterday we talked about prepayment fees. FHA loans cannot charge prepayment penalties. And FHA loans are assumable, which means the buyer can assume the seller's loan as long as the buyer qualifies. Just because the loan is assumable doesn't mean it's automatic. The buyer still has to qualify through FHA. We talked yesterday about why a buyer might approve or assume in a loan. I think if you have a lower interest rate, lower than what they're being originated at today, it'd be a good way to sell your property, be competitive to the guy that's for sale across the street. Your book on page 398, 399 talks about several different type of FHA loan programs. Just as a note, what is it? 203B, I see it now, assumption rules. 203B is the most common FHA insured loan. But there's some others as well. There's Title 1, top of page 399, Title 2, Section 245, 251. They can offer ARMs. They may offer kind of like a package loan with a loan to purchase the property and then renovation loan. So maybe if you are getting approval for a home that requires major renovations, you might be able to get that kind of package loan. Tell me in a private chat of the players of the secondary market who can purchase FHA loans. Our secondary market players who can purchase FHA loans. Thank you for that. I got Forrest Gump in the class, don't I? All right, so who can buy who can buy FHA loans? Fannie buys them all. Jenny will buy government-backed loans. I also had a student once tell me the girls. Who buys FHA loans? The girls, Fannie and Jenny. Jenny. So no prepayment privilege, does that mean they can't pay it off early? No, that means they can't be fined for pay. You don't have a prepayment penalty. No prepayment penalty for paying it off early. Yep. So Fannie buys them all. Jenny will also buy government. Freddie's not going to touch these. Freddie only wants to buy conventional. He's really picky. Questions? Okay, let's take a break. We'll come back, we'll talk about VA loans and a few other types. Cameras are on. Somebody just asked a question in the chat and it made me think. Y'all made me think. And I do have an error here. It's not that there's any, and I got a note to fix it. It's not that there's any prepayment privileges. There's no prepayment fees, penalties. That's the word I want. There. Thank you for making me think. You can pay back. You have that privilege to pay back. They will not charge you a penalty for having a prepayment, for prepaying. So thank you for making me think. Are you seeing this correctly at 6 or 7? Yeah, man, but have you looked ahead? I think one of those units is like 5 pages, and remember the weight, you guys, remember our stars. So, you know, unit 18 is not near as in depth as 7. You with me? So we're not going to spend as much time. So yeah, do we go through 6 or 7 units next week? Hang on to your hats. Trust the system. I got you. Okay, everybody make that note, make that change. I changed my PowerPoint this afternoon. Thank you. Okay, so FHA. So the next one is a VA guaranteed. Again, what a VA guarantee loan is, it's not guaranteeing the borrower money. The government is guaranteeing the lender in the event of the borrower's default. So VA guaranteed loan, what we're saying is the government is guaranteeing the lender in the event of the borrower's default. They're providing a safety net. If the borrower defaults, the government will help the lender. VA loans are operated by the Department of Veteran Affairs. VA loans are for eligible veterans. Just because you're a vet doesn't mean you're going to get a VA loan. You still have to qualify. You still have to be approved. So it's available for eligible veterans. I have this asterisk here. VA loans can also be made available to the vet's unremarried widow or widower. So VA loans may also be applicable to the veteran's unremarried widow or widower. It also applies to 1 to 4 units. Anything 5 or more, you won't be able to get a VA loan. He's also required to be owner occupied. With VA loans, eligible veterans may be able to qualify for 100% financing. If you're qualifying for 100% financing, how much money are you bringing? How much down payment do you have? Yeah, you'll still have fees. You'll still have debits, right? It's not a complete wash. But as far as your loan, your down payment, you don't have one. As with the FHA, not all vets are going to qualify for 100% financing or a VA loan for that matter. Not all properties are going to qualify. Again, the appraisal process is a lot stricter. It's a lot tighter. Before the government backs it, they're going to want to make sure that it's in good sound condition. Like we said, if the roof is 30 years old, they may not agree to back it because, I mean, I don't know, let's just make a number up. What's the average roof go for these days? $10,000. So if you have 100% financing from me, and then within a year from now, you're going to have to replace the roof as the lender, what am I going to ask? I have questions like, if you replace the roof, are you still going to be able to pay me, right? Are you still going to be able to pay that mortgage? How's that going to affect you? So not all properties are going to qualify for VA, not all people, not all vets. Vets get something called a certificate of eligibility. A certificate of eligibility is a one-time entitlement. And what that entitlement says is that this is your certificate of eligibility. This is how much you're approved for. And because they only get this one at a time, a vet can only have one VA loan out there at a time. Once you pay that off, you can qualify for another certificate of eligibility. But as a VA, you get that one-time entitlement until it's paid off. And that tells you your approved amount, for example. That certificate of eligibility determines how much the veteran can get. And again, it is one at a time. We'll see in just a second. Well, let me just say, VA loans can also be assumable, which means the buyer can assume the seller's loan. And for a buyer to assume a VA loan, the buyer that's assuming doesn't necessarily have to be a vet. Anybody can assume a VA loan as long as they qualify. The lender still has to qualify them. So if you're a veteran, you get a VA loan and you allow somebody else to assume your loan, your certificate of eligibility is still out there. Even though you don't have it, you let somebody else take it, you still only get one. And if it's still out there, it's out there. If the vet wants to buy a second home, maybe a vacation home or a rental property, they'll have to go conventional or FHA. They won't be able to get a VA loan because they already have that one-time entitlement out there. The appraisal process, the result of the appraisal process for the VA loan is a certificate of reasonable value. The appraisal will produce a certificate of reasonable value, and that certificate will tell the lender how much to lend, what the appraiser thinks the home is worth. As we just said, VA loans can be assumed by anyone. You don't even have to be a vet to assume a VA loan. You just have to qualify. The lender is going to run you through the same qualification process. Once you get that loan paid off, you can restore your entitlement. You could possibly qualify for a new certificate of eligibility. So once that VA loan is paid off, you restore your entitlement. And as with FHA, there are no prepayment penalties for paying it off early. We mentioned the other day in Unit 10, we talked about our FHA VA addendum. So if your buyer's getting an FHA or VA loan, you're going to want to make sure you include the addendum. And basically, and it's in 14 as well. So you guys got it in 2 different places if you want to look at it. It is in 10 and 14 and Learn, Test, Pass. But with that addendum, basically what we're doing is protecting the buyer, protecting their earnest money in the event the property doesn't appraise. So that's the gist of that addenda. If the property doesn't appraise, even if we're outside of due diligence, the buyer still could get their earnest money back if they choose not to purchase, if they can't come up with that difference and they choose not to purchase. There's also in your book on page 400, a nice little side-by-side comparison of FHA and VA. I would just glance through that. Don't spend all your study time on that. But I do think it kind of helps you. This is what FHA does. This is what VA does. Tell me in the chat, who are the players on the secondary market that'll buy VA loans? Who will buy VA loans? Yeah, the girls, right? What does Fanny buy? Man, Fanny is not picky. If she can buy it, she will. Fanny's going to buy it. The other one is Jenny, Fanny and Jenny. Jenny buys the government-backed loans. That's how I remember it, GG. Jenny buys government. What are the government-backed loans? FHA, and VA. Another type of loan product you may see is a USDA loan. What do y'all think of when you hear of USDA? What do you think of? If you think of a big juicy steak, you're my kind of people. So VA or USDA loans, these are our agricultural loans. These are loans set aside for rural areas. You're not going to get a USDA loan in downtown Winston-Salem. USDA loans are programs to help operate family farms, purchase and operate family farms. They may also originate, in some cases, the USDA may originate loans for single family housing for low income family in rural areas. When you start working with a buyer that's going for a USDA loan, you can actually go to USDA's website, Google after class USDA, and on USDA's website, it'll give you a map. And you plug an address in, it'll tell you right then and there if the property falls within USDA qualified area. So when your buyer says, I want to go see 123 Main Street, you go look at it before you show it to them to make sure it's in their approved area. Areas change as population increases. I mean, like my Winston-Salem people, we know rural Hall ain't so rural anymore, is it? Have you been up there lately? Have you been up 52? There's a lot going on in rural Hall. Usually rural population is considered anything less than 10,000, but as populations change, so does the USDA map. In order to be eligible for USDA, families need to be, the property needs to be in a rural area. Their whole purpose is to provide those families in rural areas with safe and decent housing. And then the families with no other financing available, again, USDA, as long as it's a rural area, USDA may be able to step in and help. That is pretty rural. A perk with USDA loans, they may offer longer than normal repayment periods. It's a hard word, isn't it? I'm sure my Northwestern Pennsylvania accent is just rural. Longer than normal repayment periods. So instead of a 30-year loan, they may take those same terms and stretch it out into a 33-year payment plan, for example. So you're taking that monthly payment, you're making it smaller because you're lengthening the time to pay it back. They eligible may provide low to no down payment. So they may offer a 0 or 100% financing if you qualify. And then they may also have subsidized interest rates, which means your interest rate isn't going to start accruing until later down the road. They may defer some of your payments. Think about your student loans. They may defer some of your payments until a certain amount of time. Again, trying to help low income rural families. So yeah, this is, I don't know if you can see this, but this is Winston, this little pin. You get up here in like Tobaccoville, Belews Creek. The yellow does not qualify for USDA, but check out Rural Hall, man. They're growing up here. So not all parts of Rural Hall are considered rural anymore. I wonder if they're going to rename. I'm just kidding. I'm just kidding. Non-rural Hall, maybe. No. Another type of financing that might be optional, and this is driving me nuts yesterday. I couldn't find it. Remember I tried to talk about seller financing? Here it is. Seller financing is also known as purchase money mortgage. Seller financing is also known as purchase money mortgage, which is easier to ask you about on your test. Seller financing or purchase money mortgage. On your notes, write purchase money mortgage equals seller financing. As with seller financing, the seller is acting as the lending institution. They're acting as the bank. The buyer, or in this case, the new owner, pays the former owner monthly mortgage payments. They agree to terms, interest rates, all that good stuff. With purchase money mortgage, title is delivered to the buyer at closing. So the buyer owns the property. We convey title, and then the buyer spends the next whatever agreed upon period paying back the former owner who used to be the seller. The difference in seller financing and installment land contract is when the title changes hands. In an installment land contract, the buyer doesn't get the deed until that last payment is made. Question comes in, is installment land contract safe for the seller in the case of default? Yeah. Because now if they're seller financing, they're standing in line with the bank, aren't they? Right? They're hoping to get in like everybody else. At least in installment land contract, they still have the deed. So they haven't conveyed anything. That's how they can protect their. I would absolutely agree. Installment land is safer for the seller. Starting on page 403, we have some other types of loans. We're just going to go through these pretty quickly. Green Star, basic understanding. A package loan combines the purchase of real property and personal property. If, for example, you're buying a fully furnished condo at the beach, you would do so using a package loan. Not only are you buying the condo, but you're buying the wicker living room set and the bedroom furniture, dining room table. You're buying real property and personal property. A bridge loan is a short-term loan that's meant to fill the gap from where one loan ends and another loan originates. If there is a period of time between this one ending and this one starting, a bridge loan will fill the gap. Think about what a bridge does. Short-term loans, just to cover that period, of time. A blanket mortgage covers more than one parcel. It covers more than one property, more than one piece of land. Think of, for example, a developer coming in and buying 3 parcels so they can combine them and then subdivide them, create a subdivision. They may buy land from this person, that person, and this person. They could do so using a blanket mortgage. An open-end mortgage. An open-end mortgage is a line of credit or equity. The lender may allow the borrower to use their property as collateral. So it's a line of credit. Construction loans are kind of tricky. Construction loans, the buyer is asking for money from the lender for a product that doesn't exist yet. They want to build, and they're asking the lender for money. We're standing on dirt. It's not uncommon with construction loans for the lender to release the fund in stages. So they'll come out periodically through the construction process as the home is being built. Once they see this is complete, before we go to the next stage, they'll release new funds. Helps protect their interest in case construction stops. A buy down could be a type of loan that buys down some of your interest. Maybe you had to originate at a really high interest rate. You may later qualify for a buy down that'll help you lower that initial offset, that initial interest rate. Home equity loans are awfully similar to open-end mortgage. They are also a line of credit. Probably the big difference, home equity loans might be specific for paying off big debt. So maybe you have major medical bills, for example. Home equity loan, again, you're borrowing against your residence. You're using your property as collateral. But with a home equity loan, maybe you want to do a major renovation. Maybe you want to add on to the back or something. You might be able to do that using a home equity loan. And then a reverse mortgage is exactly how that sounds. Instead of you paying the lender's paying you. In order to qualify for a reverse mortgage, you've got to have equity in the home. If it's not paid off in full, it's got to be close. So instead of selling your home and collecting one lump sum, if you qualify for a reverse mortgage, you may be able to have the lender start paying you. Of course, that's going to affect what you owe at the end, how that's paid back. Reverse mortgages are often set aside. Think of seniors that have pretty much paid off their home. They might be able to use this to help supplement their Social Security and Medicare. So how is it different from a home equity? Home equity, you're borrowing money against your home. You're getting another loan. Reverse mortgage, the lender's paying you. Y'all start paying attention to commercials. Have y'all noticed Tom Selleck has been the recent spokesman for reverse mortgages? Did that make you feel old when you saw Tom Selleck? It made me feel old. So again, you have equity. You either have it all paid off or a good chunk of it. You've been in it for a long period of time. And the lender will send you there. Instead of selling it, get one lump sum, the lender's sending you payments. And it'll have to come out. When you do sell, it'll have to come out, of course. But again, for senior citizens, it might be a way to help them offset their credit a little bit. You're not borrowing, they're just paying you their equity. You will still owe them money, right? You're still going to owe them money at the end when you do sell it, but they're sending you a check every month. Mortgage priorities. We're good with this, yes? Liens are paid in the order in which they're recorded. So your first mortgage, your second mortgage, your third mortgage, etc. It's all paid in the order in which it's recorded. Your senior mortgage is your first mortgage. The mortgage that you originated when you purchased your home is your senior mortgage. The only difference, yeah, you're either borrowing money, one lump sum, or they're paying you in installments. Yep. Your junior mortgage is your second mortgage, your third mortgage, your fourth mortgage. So your senior is the one you originate. Your junior is any mortgage after that. A subordination agreement. If you subordinate, you agree to place yourself in a lower ranking. So you buy the home, you originate your senior mortgage, and then somewhere down the road, you apply for a second mortgage that's known as your junior. Lien priority says which one's going to get paid first. Lien priority says who's going to get paid first? Senior mortgage, right? Because they recorded first. They recorded the day you bought your home, the day you closed. The junior mortgage is next in line. They're get paid after the senior. Let's say you decide you want to refinance your senior mortgage. You want to do a refinance. If you refinance, your senior mortgage has to re-record, and now they're in line to get paid after the junior mortgage. Does the senior mortgage like this? No. And if you have a junior mortgage, the only way the senior mortgage will agree to refinance is if they can get the junior mortgage to subordinate. If they can get the junior mortgage to agree that even though you're refinancing and re-recording, the senior mortgage still wants to get paid first. So if anybody's subordinating, it's the junior mortgage, and what they're doing is agreeing, even though the senior mortgage re-recorded after they finance, the junior mortgage is agreeing to keeping themselves in a lower ranking. The junior mortgage is agreeing to still be paid after the junior mortgage. I see what you're saying now. Senior mortgage is your first mortgage. Junior mortgage is your second mortgage or your third mortgage. Anything after your first are your junior mortgage or junior mortgages. See? How we doing? Doing good? How do you have more than one mortgage? Oh, yeah, people get second mortgages, third mortgages. They got to apply, they got to qualify. Second mortgage interest rate is going to be high because there's risk now, right? Because the junior mortgage, the second mortgage knows that there's another mortgage standing out. I told you guys yesterday about my short sale, my 11.5-month short sale. Y'all know why it took 11.5 months? Because these sellers had 3 mortgages on the home. They had a failed business that they attached to the home, and they had outstanding debt to the IRS. All of those lien holders, they had a lot more debt on the house than what it was worth. That's why it took 11.5 months. Why not just refinance? I mean, then refinance. Don't get a second mortgage. I can't answer those questions. It's a case by case, guys. Your credit's different than my credit, right? Maybe you qualify for a refinance and I don't. My only other option is get a second mortgage. Maybe I need money to do something. Refinancing is only going to lower my payments. If I need lump sum to do something right now, getting another mortgage, borrowing on my home might be my option. Okay. What did they do to get to close? We had to get all those lien holders to approve. All 3 mortgages, the failed startup business, whoever that loan was with that was attached to the home, and the IRS. I don't know if you guys are aware, but rapid responses from the IRS are not that common. They tend to take their time. If you're subordinate, you're agreeing to put yourself in a lower position. The junior mortgage would have to agree to subordinate in order for the senior mortgage to refinance themselves. Senior mortgage is your first mortgage. Junior mortgage is any mortgage after that. So let's talk about some residential lending practices and procedures. I think this is the section that applies mostly to us because, again, we're with the buyers and we're helping the buyers and we're answering questions for the buyers. So I think this is the probably most in practice section that we have. First off, we need to understand the lender's loan application. And the loan application includes information about the borrower, it's information about the property, and it's information about the loans itself. Information about the borrower that the lender has to collect. They need employment, debt, monthly bills, how much you have to pay each month for your bills, assets, all your assets. They're gathering financial information about the borrower. Information they want about the property is the legal description, possibly a survey. Are there any other outstanding issues with the property? And then, of course, information about the loan. How much is the borrower asking for? What's the interest rate? What's the monthly payment? Possibly mineral rights. If mineral rights have been severed, that's a great one. The lender may care about that. We're going to talk more about the loan application in Unit 21. And specifically, we're going to see what is considered the loan application. The lender's looking for 6 pieces of information. And once they get those 6 pieces, then they can start the loan application. So we'll see that next week. One of the biggest things that brokers can do to help our buyers throughout the transaction is to help them understand. The lender's having a conversation with them as well, but people need to hear this twice sometimes. The way the mortgage lender does this, when you do your loan application, when you're applying for a mortgage loan, they take like a snapshot of your credit. What does your credit look like today? What's your income and what's your debt? And they kind of take a snapshot of your credit today. Now fast forward to settlement. And they're going to take a snapshot of your credit again. If those 2 snapshots don't match, then we got a problem. Your income needs to be relatively the same. Your debt needs to be relatively the same. And one of the best things that we can do as brokers is to encourage our buyers not to run out and buy a brand new car for the brand new garage before they close. They're going to get excited and they're going to want to go to Rooms to Go and open an account. Don't do that until after you've closed. Y'all, this is true stories. This stuff has happened. Buyers get excited. They go out and want to celebrate and buy a new car, and then they don't get the loan approval. So now they have this nice new shiny car and they have no garage to put it in because they got denied the loan because their snapshot changed, their credit changed. So what's one thing we can do to protect our consumers? Tell them, don't open any accounts. Don't close any accounts. Keep your income as close as you can. Keep your debt as close as you can. Of course, you can still go out and have dinner, right? I mean, we're not saying you can't spend any money, but we're saying the snapshot of your debt to income ratio needs to look the same, or else we may not get loan approval, or we may have to delay closing, because in a sense, the lender has to start over. If you go out and buy a new car, the lender's got to start their process all over. I actually had a teammate once. Buyers went out and bought a new car. She was devastated. She's like, I cannot believe they did that. Guess what? That nice new car tipped them over the edge and they got denied their loan. They couldn't buy that house. She was spitting mad. I mean, spitting. You know how you avoid this? You talk to your buyers early on. Once you submit your loan application, keep your credit looking pretty much the same. One thing that lenders will look at is the credit score. Please understand, this is not the only thing that the lender looks at, but they do consider the credit score. Most credit scores range from 300 to 85. The higher your score, the lower risk you are to the lender. What's a credit score of 800 say? A credit score of 800 says you pay your bills all the time, every time, right? Doesn't that look good to a lender? Don't they like to see that? If you have a credit score of 400, the lender may not be willing to take that risk. Again, all lenders are different. They all have a minimum that they're willing to work with. I know some lenders that'll say if your credit score is under 560 or 600, I can't help you. A good lender will help a borrower get that credit score up. A good lender will have a conversation with that borrower about what they can do. Why is a lender spending their time with that now? Because once that buyer gets their credit score up, the lender wants them to call them again, right? If you're an agent working with a buyer that has a low credit score, stay in touch with them, because once they get their credit score up and they're ready to buy, don't you want them to call you? So to reach out to them, put them on your quarterly newsletter, mail them, call them every once in a while and ask them how little Susie's doing in school. Stay in touch with them. So when they do get that credit score up and they're ready to buy, they will call you. Sometimes we have to incubate buyers. Medical bills, yep, medical bills can help credit scores. Another thing that lenders consider is your credit history. The underwriter, who we'll talk about in just a second, is going to look at 2 years of your detailed history, debt and income. They're going to want to see 7 years of your repayment history. Remember what we said, if you're not a W-2 employee, if you don't get a paycheck every other week, they may want to go back further than 2 years. If you're a real estate agent, they may want to see 4 years, for example. But they're looking for that history. They're looking for the strong pattern. Underwriters may be willing to make an exception. If you have some blemishes in your past, medical issues we just mentioned, death, divorce, death of a spouse, I should say, divorce, they may take that into consideration. If you have a less than stellar credit history, you may not qualify for an FHA or VA loan. Prior to the housing market crash, I don't know what underwriters did, honestly. Everybody got a loan. It was so easy to get a loan. Now, man, underwriters, I tell you what, they don't leave a single stone unturned. They dig, and they dig deep. At some point after the loan application, while we're processing the loan, underwriter gets involved. At some point, the lender's going to want to do a rate lock. And once the lender locks in your rate, that is your interest rate for the life of the loan. So at some point between loan application and closer to settlement, the lender's going to want to do a rate lock. So if we lock in today for 4.5%, and tomorrow the interest rate drops to 4%, you're already locked in at 4.5%. If we lock in today at 4.5% and tomorrow it increases to 5%, you're okay, because you're locked in at 4.5%. Once you're locked in, this is your interest rate for the life of your loan. So what's all this mean for us? We need to have a basic understanding of how lenders decide whether or not to approve a loan. Again, please note, basic understanding. Question comes in, if interest rate goes down after it's locked, can you change it to lower rate? No, because you're locked in. If you lock in at 4.5 and tomorrow it's 4, you are already locked in at 4.5. Having a basic understanding of the process. There are 2 forms of qualifications. Lenders may offer a pre-qualification, just pretend that's spelled right, and a pre-approval. I know, okay. So pre-qualification and a pre-approval. A pre-qualification is the first step in the process. The pre-qualification looks at the debt to income ratio. How much debt do you have? How much money do you make? The lender in a pre-qualification doesn't verify those numbers. In a pre-qualification, you tell the lender, this is how much I make and this is what my debt. And based on what you tell them, they tell you what you're pre-qualified for. Pre-approval is taking it a step further. You tell the lender your numbers, and then the lender verifies it. They ask to see your credit history. They ask to see your pay stubs. It's a second step in the process. What's important for us to understand, neither one of these is a definite approval. Neither one of these is a guarantee. Just because you have a pre-qualification, or better yet, a pre-approval, is still in no way guarantee that you're going to get final loan approval. Part of the loan application is information on the property, which means we can only go so far in the loan process until we get a signed contract. Once we're under contract, now the lender has information on the property and they can actually start the rest of their process. There is no guarantee until you get that final loan approval. When you get that final loan approval, you and your buyer will get an email from the lender, and that email will say you are clear to close. 3 of my most favorite words in this industry: clear to close. And once you get the clear to close, you know you've gotten your final loan approval. Guys, here's the deal. It's not uncommon to get the loan approval after due diligence and a few days before settlement. It's really, really, really rare to get final loan approval while we're in due diligence. We go under contract, do your mini celebration. The buyer's agent, as soon as you get a signed contract in your hand, you need to immediately send that thing to the lender so they can start doing their thing. The lender's got to order the appraisal. They got to gather more information from the buyer. Tell your buyer to make the lender their priority. If the lender calls you and says, I need this document, then get them that document. Once the lender has gathered that information, then they send all that to their underwriters. And their underwriters are the ones that dig deep. They dig deep. They crunch those numbers. They study those things. They get all sorts of involved. It's not uncommon for a loan to come out of underwriting the first time with the lender requesting more information. It's not uncommon at all. So if you come out of underwriting and the lender says, okay, now I need this, this, and this, your buyer needs to get it to them. Would it surprise you guys if I told you there have been times that buyers have delayed their own closing because they don't respond promptly to the lender? So again, how can we help in this transaction? Tell your buyers to make the lender a priority. If the lender's asking for it, get it to them. They're not going to do their thing unless they have all the information. Once it comes out of underwriting the first time, from there, hopefully we're still in due diligence. Hopefully that's what our due diligence period is for, is to get all that together, all that processed, and get it out of underwriting the first time. And what we can get, or what the lender can get that first time from underwriting, is a pretty good idea of whether or not we'll get loan approval or not. Your buyer, based on the lender's pretty good idea, needs to make a decision to either terminate within due diligence and get their earnest money back, or continue on with the transaction and hope that they get loan approval. We have no guarantees until we get a loan approval. So it comes out of underwriting. Lender requests more information. Borrower submits it. Usually when it comes out of underwriting the second time is when we have our definite answer. Either you get loan approval or you don't. If the buyer's not going to get loan approval and we're after due diligence, they will have to terminate. And the seller will keep the due diligence fee, and now the seller's going to get the earnest money. Question comes in, if a prospective buyer comes to you and says, how much money do I need to bring to buy a house? Would we tell them to call a lender or an accountant? No, actually, I get to tell them how much they bring to settlement. And that's the math we get to do in Unit 21. If my buyer comes to me and says, how much house can I afford? Then I'm going to have them call a lender. But if they say, how much do I have to bring to closing? I get to help them with that. Once you work with a lender a few times, you get a feel for how long they need to get for their process. Again, every lender is different. They all have different processes. So once you work with a lender for the first time, you kind of get a feel for their timelines. That lender timeline may help you determine how much due diligence time to ask to request in your buyer's offer. So I know that's the question. How much due diligence? How much due diligence? If you've never worked with this lender before, I suggest you pick up the phone and you ask them, how much time do you need? Because we want to at least, at a minimum, get that loan through the first round of underwriting to get a pretty good idea while we're still in due diligence. So if you're not familiar with the lender, ask them, how much time do you need? And get that time for your buyer. What questions do I have? Anything so far? I see they're coming in as we go, which is great. Just some things that underwriting looks for. They're going to look for credit characteristics.
Boy.
Yeah. Question? They're going to look for credit characteristics again. They're going to study your history. They want to know who you are as a creditor. They're going to look at all your assets. How stable is your income? Do you job hop? Is your income acceptable? Lenders have to be able to source cash. When it comes to mortgage lending, cash is no longer king if you can't source it. If you have money stuffed in your mattress and you want to buy a house, I suggest you go ahead and get it at the bank now. So 6 months from now, they can see that it's in your bank. You cannot just show up to closing with a big bag of cash and say, here you go. They have to be able to source it. Another thing to blame for the housing market crash was money laundering, mafia money, for example. So now they're on the lookout for that. Is your money source legal? How did you make your money? If y'all want to learn about money laundering, just watch the Ozarks. Yeah, exactly. Take note. Show up with your pad and pencil. But again, that was a concern because they couldn't source cash. And I'm not saying you can't buy a house with cash today. I never said that. I'm saying if you want to have cash involved, you have got to be able to source the money. You've got to be able to prove where it came from. How does your assets help? Good question. Remember with short sales consist, for example, of 3 pieces. Can you sell the home for what it's worth is piece 1, but then the second piece is, what are your liquid assets? So what the lender wants to know is if you stop paying me, if you can't make your payment and you default, what else can you sell for me to get my money back? What else do you have for me to be able to help get my money? They want, guys, there are no stones left unturned. I once had a buyer look at me and say, I just feel like I have formed a very intimate relationship with my lender. And I said, well, that's a pretty good way of putting it. They get all up in your business, your financial business today. Nice. Okay. All right. Take our last break. When we come back, we'll keep going in 15. Welcome back. Okay, I'm gonna take attendance. Cameras are on. Smile. Okay, so underwriting, again, just referring to the more of the process of them, like I said, crunching the numbers, digging deep, learning everything they can about the creditor. It's not uncommon to come out the first time from underwriting requesting more information. They're not saying no, they're just saying, I can't give you approval until we learn a little bit more. So again, one thing we can do as brokers is to help keep our buyers moving in the transaction, help them communicate. Guys, without a doubt, the lending process is the longest part of the contract to closing process, without a doubt. Getting that lender approval is the longest. So that's why the moment you go under contract, right, the moment you get that signed contract in your hand, mini celebration, but then immediately get that contract to the lender so they can start. I sometimes think of underwriting as like this black hole somewhere, because you call your lender to check on the process of the loan and they say it's in underwriting. And I always think, where is that? You know, where can I find that? It's like this little intangible place somewhere that you can't touch, but they're there working hard, making sure that the borrower qualifies, protecting the best interest of the lender. When the borrower is crunching numbers, one thing they crunch are something called qualifying ratios. Typical ratios for the conventional loan, 2836, FHA 3143, VA 41. We probably won't get to this math today, or we might get started on it. When we get to the math of qualifying a buyer, that's when we're going to use these ratios. Particularly, we're just going to focus on the 2836. So I will talk about what those ratios mean in just a minute. Again, we'll probably get started on this today, which means this is where we'll pick up on Tuesday. So just hang on to this for now. And we'll talk about what that 28% of what and 36% of what, we'll talk about what that means when we get to the math. Yes, and thank you guys for telling me you're back. Not only do you tell me you're back, but don't forget to pop your camera back on too. Okay. I remember we introduced you guys to TILA earlier. TILA is the T in TRID. TILA is the T in TRID. TILA is also known as Regulation Z. You need to know that TILA is Regulation Z. TILA tells the consumer the cost to obtain the loan. It gives the consumer the true cost of obtaining credit. How much is it going to cost me to get this loan? TILA and TRID apply. It's a lender law. It applies first off when the buyer's getting a loan. And it applies when they're purchasing using that transaction secured by a resident. So all of our mortgage loans, most of our mortgage loans are going to apply to TILA. If your buyer is a cash buyer, TRID's not around because TRID's a lender law. So TRID's only around if a lender's involved. Everybody with me? If it's a cash buyer, there is no lender. So if it's a cash buyer, the rule is there are no rules. We don't have to follow lender laws. Yeah, thank you. By the way, you guys, it looks like we got some storms, at least in my area, some storms coming. I hope they hold out for about 53 more minutes, but you just kind of, if you're in an area with storms, hopefully I'm not right now. So hopefully we can get through this last hour. As mentioned earlier, TILA is administrated by the Consumer Financial Protection Bureau. We did not get the CFPB until after the housing market crash. That was a result, help protect the consumer. And another thing that they can do to protect the consumer is to help educate the consumer, help fully inform them about the terms of the loan. Y'all, they're getting ready to make a 30-year commitment. Don't they have a right to understand the terms of that commitment? I mean, don't they have the right to know? And it used to be, I'm not kidding, prior to the housing market crash, some lenders would say, sign here. And if the buyer had a question, like, don't worry about it, just sign here. You're making a 30-year commitment. You have the right to know, and TRID agrees. And so a lot of the things that we can do to protect the consumers help educate the consumer. Particularly, TILA says that the consumer needs to be fully informed of these things known as chief disclosures. Chief disclosures are on the very next page, so bear with me. So TILA feels that the consumer should be informed of these chief disclosures. What are the chief disclosures about a loan? The APR is the annual percentage rate. Annual percentage rate. APR is bigger than interest rate, more than interest rate. APR looks at the relationship of all the financing charges, including the interest rate. So the APR is the relationship of all of the financing charges, all of the fees charged. It does include the interest rate. A chief disclosure are the financing charges associated with the loan. The total and amount, number and amount of payments. Remember, a 30-year loan, you're going to be making 360 payments, right? 12 times 30 gives you 360. How much are those payments going to be each month? What is your monthly debt service? And then how much you're going to finance? How much are you going to borrow? TILA feels that the consumer needs to be fully informed about this information. Another big thing that TILA did for the consumers was put regulations on how lenders can advertise. So they put regulations on lender advertising. And one way they did that was identifying trigger terms. A trigger term is a specific number about the loan. And what TILA tells the lender, what TILA says, is that if in your ad, you mention a specific number, and we'll talk about what those numbers are. In your ad, if you mention a specific number, then you have to give all of the financing terms. If you mention a specific number about the loan, you've got to give all of the information. Let's consider this. Every single one of us on this call has a different credit score, credit history, right? We're all different. We all have a different credit story. If the lender advertises to all of us 100% financing available, what the lender is telling each and every single one of us that we can all get this loan for zero down, they're going to give me 100%. And what TILA says, if you're bold enough to offer everybody 100%, then you need to include all of the terms. In practice, because we are all different, I have no idea what your credit history looks like, but I know we have different. If we really wanted to have fun today, we could all 53 of us, call the same lender and try to get approval for the same property, the same amount. We could all try to get 80% for 123 Main Street. But because we all have a different credit story, we're all going to walk away with different results. Some of us will get 80, some maybe 90. We're going to have different interest rates, different payment plans, right? Because we're all created differently when it comes to credit. So what TILA says is, look, lenders, if you're going to be bold enough to say that every single person you advertise to can get 100% financing, then you need to disclose all the terms. They need to make it a one size fits all. Is that not good consumer protection? They're not going to say 100% financing. They may say low financing, and they can say low financing because they haven't hit a specific number. But what they cannot do, what TILA is refusing for them to do, is to have like a one size fits all loan. Because the idea of a one size fits all loan does not work because we're all different. Do I have everybody? So when the lender advertises, they need to make it clear, you may get one interest rate, you may get another, you may have different financing than you do. And that's why they don't allow specific numbers. So when we talk about trigger terms, things that are considered trigger terms, and again, we'll look at examples in just a second. If in the advertisement, the lender advertises the amount of the down payment that you need, specific number, $500 down to originate this loan. If they specific numbers say the amount of the down payment, TILA says the lender's hit a trigger term. The amount of any payment, not just the down payment, but monthly payment, for example. How many payments? I may go for a 15-year loan while you may go for a 30. Period of repayment, again, 15 versus 30 years, or the dollar amount of the finance charge. If any of these trigger terms include specific numbers, TILA says the lender has to advertise everything. It's a one size fits all. Does this apply to, I don't know that question. What I know is TRID applies to mortgages. So I'm not sure if the auto industry has, you know what I'm saying? I'm not sure how lenders of other things, if I'm sure, I hope they have rules, but I'm not sure. What I know is TRID is about the mortgage. Good. Before we look at some examples, let's put this in practice for a second. Why the heck is this important to me, Julie? I'm going into real estate. I'm not going to become a lender. I'm not going to be doing advertising for the loan. Why do I care about this? I hear you. I hear you loud and clear. So let's say you're licensed and you get a nice new listing and you decide next week you want to do a broker open. So you put out you want to, have all your fellow agents, invite everybody in the area to come to your new listing so they can ooh and ah over it. And, hopefully bring their buyers later, right? Introduce them to the property so they can bring their buyers. And at your broker open, you're going to do an afternoon event. So you're going to have wine and charcuterie. By the way, real estate agents jumped all over the charcuterie craze. That's about all we ate for, and anything goes with wine, right? So you decide you're going to have wine and charcuterie at your broker open next Thursday from 3 to 5. Maybe as part of your broker open, you call your lender buddy. And you call your lender buddy and say, hey, I'm doing a broker open. You want to go in on it with me? Your lender buddy very well may say, heck yeah, I want to go in on it with you. Because that's an opportunity for your lender buddy to meet more agents, right? We can get them there, we can meet them. They can bring their buyers and maybe the lender can expose themselves to other agents. So then your lender buddy says, yeah, I want to go in. That sounds great. I look forward to it. I'll provide the wine. You say, great, sounds good. And then your lender says, I'll make up the flyer. And your lender makes a flyer to advertise the broker open. And they put your name, your picture, your email address, and your phone number on it as well. And then that flyer goes out with a trigger term. Isn't your information on there? Aren't you advertising, even though you didn't do it directly? Aren't you advertising trigger terms? So why do we need to be aware with this stuff? Because we work so closely with lenders. Because we work so closely with them. So we need to be aware of these things. And I'm not saying your lender buddy is shady and is going to try to harm you. What I am saying is you may want to say, do the flyer. That sounds great. Let me proof it before you send it out. It's better to have two sets of eyes on it, especially if your name and contact information is attached to it. Do I have everybody? So why do you care? Because we work with lenders. We need to be aware of how this works. So let's look at some specific. Let's look at some examples when we talk about a specific number. A specific number is $600 monthly payment. That's pretty dang specific, isn't it? How can they avoid hitting that trigger term? Maybe instead the ad says low monthly payment. Do you guys see the difference? A specific number would be $0 down. So again, maybe wait, instead of 0 down, we say low down payment. What trigger terms, what Tilla says is if we hit a specific number, and this is where I need you guys to make sure you hear me, about the loan. About the loan. Is the purchase price about the loan? No. Can I advertise the purchase price? Yes, because it's not about the loan. Is the monthly HOA due about the loan? No. So can in my MLS listing say HOA dues are $50 a month? It's got to be a number about the loan, not just any number, a number about the loan. Oh, look, I have no slide for you. So when we talk about the loan, is the list price about the loan? Is the HOA dues about the loan? No, we're looking for financed amount, down payment, payment terms, etc. Tilla says, if a trigger term about the loan is hit, if a specific number about the loan is hit, then the lender also has to disclose the total amount of the loan, the actual down payment, frequency number, actual interest, total required payments. Basically, what I'm saying here, if a specific number is hit, if a trigger term is hit, the lender has to disclose everything. If one number is hit, they have to disclose all. And basically what they're saying is they're making this loan a one size fits all. Are loans one size fits all? Absolutely not, because we all have a different credit story. What they're saying is the person with a credit score for 825 falls in the same category as the credit score with 400. They need to keep it general so they can do it on a case by case. So here's your, if a trigger term is hit, if a specific number about the loan is hit, then all of this information must be provided in the ad. Gee, Julie, what's the big deal? It's just a flyer for a broker open. What harm can it cause? Your book on the bottom of page 409, see it for yourself. We're looking at penalties, up to $10,000 per violation. You could be looking at other fines, possible prison time, and do your head one way or another. Do you see disciplinary action from the North Carolina Real Estate Commission? Talk about kicking you when you're down, right? Here's a year in jail, $10,000. Oh yeah, and you're going to lose your real estate license. So what's the big deal? You going to proof those flyers before they go out with your name on them? Oh yeah. You know what else we're getting ready to see? I'm predicting the future again. Remember we said earlier that as interest rates start creeping up, you know, last year they were like 2%, 3%. Today it's probably 4 point something, maybe 5. I don't know. I didn't look today, but they're starting to creep up a little bit. You know, by next year, they could be 5%, 6%, right? They're starting to come up. Interest rates are coming up a little bit. And if interest rates go up much more, then it might be desirable for the seller to offer the buyer to assume their loan. So instead of originating a new loan at 6%, you can just take over my loan at 2%, right? Which one would be more desirable to the buyer? You and I need to be careful. If you're the listing agent and you're listing a property where the seller wants to assume their loan, can I say in my MLS comments that the seller's loan is assumable with a 3% interest rate? Didn't I just hit a trigger term? This is getting ready to be big. This is getting ready to be a thing. As we start assuming loans or buyers assuming seller's loan, this is going to be the big place that you and I need to be careful on how we advertise our listing. Instead, all we need to say is buyer may be able to assume the seller's loan. That's pretty general, isn't it? But if you in your MLS remarks say seller's loan can be assumed for a 3% interest rate, you just hit a trigger term and you just violated TRID, and those penalties again at the bottom, page 409. That's my crystal ball. That's my prediction. So that's what TILA does for us. Very briefly on TILA, pretty much again with TILA, the T in TRID, advertising. Now, when we get into 21 next week, we'll talk more about TRID and we'll talk about RESPA. Somebody said, so never add a guaranteed number. Exactly. Stay away from specific numbers about the loan. Can I go on my Facebook and say I have a property for sale for $350,000? Yeah, because it's not about the loan. I know you guys on your tests and you see a number and you get excited and be like, oh, there's a number I can't. That's why I need to stress. It's a specific number about the loan. When you see a number, ask what it's about, ask what it relates to. Lenders also have some other laws. Of course, TRID is one of them. Lenders have some other laws as well. One law that lenders have is the Federal Equal Credit Opportunity Act. How do we know this is a lender law? Because the word credit's in it. This is a law about obtaining your credit, Equal Credit Opportunity Act. Sorry, I must not have seen it, or maybe it doesn't apply. I don't know. When they say the APR, how does that become a trigger term? APR is not a trigger term. APR is not a trigger term. Thank you for bringing me back to that. APR is a chief disclosure. So if a trigger term is hit, APR is one of the things that you have to disclose. Okay. Equal Credit Opportunity Act. This prohibits the lender from discriminating against any credit applications on the basis of race, color, religion, national origin, sex, marital status, age, or any dependency on public assistance. This is the lender's protected classes. By the way, when we talk about age, minors are exempt. Obviously, a 17-and-a-half-year-old is not going to get approval for a mortgage. So minors are exempt. When we say age, what we're referring to, if a 90-year-old walks into the bank and asks for a 30-year loan, they cannot be denied that 30-year loan because they're 90 years old. Age is a protected class, as long as they're an adult. If you're denied credit, if you're denied the loan, the lenders are required to let you know why within 30 days in writing. And the reason why had better not be because any of the members of the protected class. If you're denied a loan, it better be because your debt to income ratio does not work out. Unit 19 for us is our fair housing, and we're going to see a lot of these same classes again. As a matter of fact, we'll do a nice side-by-side comparison. Our protected classes have a few differences than the lender's protected classes, but we need to understand what the lender's protected classes are. So we'll see this again when we get to 19. The other thing that the lender has is Fair Credit Reporting Act. This gives us as consumers the right to check our credit report and demand that mistakes be made or corrected. What are the three? Equifax, it's in here. I never remember. Where are they? Equifax, Experian, and TransUnion. I'm at the last page 410. So if you check in your three, if you're checking your credit report each year and you find an error, you have the right to correct it. Y'all, please, if you're not, please get in the habit of checking your credit report. People get scammed, people get hacked, people get blemishes on their credit report and they don't know until they're trying to apply for a home loan. So if you're not in the habit of checking it once a year, well, isn't today a great day to start after class? Please don't go check it now. The Fair Credit Report information is good for up to 7 years. They're going to look at a 7-year history. Bankruptcy stay with you a little bit longer. If you face a bankruptcy, it could go back 10 years. Again, the important thing here, this is our act. This is what protects us as consumers, giving us the right to check our credit, check our records. What's that? What, like karma.com? That's one of them. You can check them. Several different places. I would go to our old friend Google, do a search, see which one you like the best, and have an idea. Again, so many times buyers go to apply for a mortgage loan and they find out about a credit card that was opened in their name 3 years ago that they had no idea about. Scammers and hackers and bad people are out there. So do what you can to protect yourself. Some banks offer them. That's kind of cool. Credit card, cool. You can see all three. That's cool. I didn't know that. We learn something new every day, don't we? Loan fraud. Loan fraud's bad. Loan fraud is just bad. If you're committing loan fraud, you're making a false representation in order to obtain money. You are lying on your loan application. And if and when they discover that lie, that's not a typo. You could be looking at fines of up to $1 million and or 30 years in prison. Remember earlier when we talked about borrowing money from the bank of mom and dad versus mom and dad giving you money? And they say, yeah, it's a gift. And the lender will make them sign that. If we find out later that they lied, your parents are going down for loan fraud. Don't do that to your parents. Lenders also have a North Carolina Predatory Lending Act. These just put, there's restrictions on high cost loans. Again, there's lots of ceilings out there to regulate the lenders to protect the consumer. It's what it's all about, protecting me and you. Consumer protection, they put regulations on various things. What if they gift the money and you choose to pay it back? You better call your lender. What if? You better call your lender. My parents were kind enough to give me $5,000 at closing. Now I've come into some money. Can I pay them back? Very brief blip in your book on 411. We just mentioned it here. We're going to spend a little bit more time with RESPA in Unit 21. And remember, when you see RESPA, see settlement. RESPA tells the consumer the cost to close. TILA tells the consumer the cost to get credit. RESPA tells the consumer the cost to close. questions? Please look with me. Before we get into the math of 15, let's first look at your book on pages 412 and 413. And what you're looking at in your book at 412 and 413 is a mortgage factor chart, also known as a rate factor chart. Use them interchangeably. You do not need to memorize that. I get asked this all the time. Do we have to memorize it? No, you don't have to memorize it. If you ask me after today, I'm going to tell you you do. So no, you do not. We do need to know how this thing works. I have heard from former students that go to PSI Testing Center that this chart is like blown up and on the wall at PSI Testing Center. And when asked what the rate factor, the mortgage factor is, they actually have to look at the wall and look it up. So what we need to do first is know that we understand how this chart works. The first column is your interest rate. We can see how out of date our book was. When our book was published, the lowest interest rate was 4%. Last year, we were generating them at 2%, 3%. So obviously this isn't an up-to-date chart. However, it still works. The first column is your interest rate. And then all the columns after that are the terms of the loan. Is it a 10-year loan, a 15-year loan, a 20-year loan, a 25 or a 30-year loan? Everybody see that? So to find your mortgage factor or your rate factor, you first find the interest rate and the term of the loan, and then you get a number. And that number that you get is one that we're getting ready to use for the math on the next slide. Let's do a, put something in the chat for attendance purposes. And what I want you guys to tell me in the chat, all of you, what would your mortgage factor be on a 4.5% interest rate and a 15-year loan? I need to hear from each of you. You don't see the chart, page 412, 413? I need to hear from each of you. And if you don't know, tell me you don't know. I'm doing this for attendance purposes. If you have a 4.5% interest rate and a 15-year loan, what is your mortgage factor? What is your rate factor? And I'm hearing from everybody. Or at least if you want to be counted present, I'm hearing from you. Pages 412 and 413. Did I hear from everybody? 4.5%, 15-year loan. So you go down, go your rate, take your finger, go down till you get to 4.5%, and then you go over till you get to 15. Your mortgage factor is 7.65. Pages 412 and 413 in your book. So again, 4.5%, 15 years, your mortgage factor is 7.65. So what the heck is a mortgage factor? A mortgage factor or rate factor is the number that the lenders use to help them determine your monthly debt service. How do we calculate your monthly principal and interest? Remember yesterday we amortized the loan and we were given the monthly debt service, $499.55, I believe. Question came in, are they always going to give you the monthly principal and interest? And the answer is no. However, if they don't give you the monthly principal and interest, they will give you the information that you need to find it. So they're either going to give you your monthly debt service, or they're going to give you the loan amount, the rate factor, or they're going to have a big chart at PSI Testing Center and let you find the rate factor. Is it always divided by 1,000? Yes, because that's what the formula says. So how do you find your monthly debt service? Loan amount times the rate factor divided by 1,000. This is a formula that you just need to know. How do we memorize formulas? We put them on flashcards. We write them down 20 times so that repetition gets them stuck in our head. I highly recommend flashcards for all formulas. If you don't know the formula, you don't know what to do with the problem. Have this written down. Loan amount. How do you find your monthly debt service? Loan amount times the rate factor divided by 1,000. Everybody good? Tell me in a private chat what the Miller's monthly debt service for their loan will be. Loan amount times the rate factor divided by 1,000. Loan amount. What's the loan amount? Times the rate factor or the mortgage factor divided by 1,000. About 30 more seconds. So the Millers are borrowing $350,000 at 4.5% annual interest for 30 years. Using the mortgage factor chart, it is determined the mortgage factor is 5.07. What will the Millers' monthly debt service be for this loan? Loan amount times the rate factor divided by 1,000. Yes? Don't I have some distractors in this problem? If you don't know the formula, you're trying to do something with those numbers, aren't you? Just because you see a number in a problem doesn't mean you're going to use it. Those numbers are called distractors. What's the distractor's job? To distract you. How do you beat distractors? You know the formula. I'm not kidding when I say this. Knowing the formula is like 80% of the battle. If you know the formula, you know what numbers you're looking for, you know what you need to do. So we know our formula to find the monthly debt service. So we take the loan amount times the rate factor, and then we're going to divide it by 1,000. So the loan amount of $350,000 times the rate factor of 5.07 gives me 1,700,000 something divided by 1,000. So what's my monthly debt service? What's my monthly principal and interest payment? $1,774. I'm going to go back just for 1 second. Let's make sure we all have this written down, please. To find your monthly debt service, you take the loan amount times the rate factor, also known as the mortgage factor, and you divide it by 1,000. Divide it by 1,000. Oh, thank you. Sorry. Well, that's not helpful, is it? There you go. Good point. Somebody said you got that and you divided by 12. Again, knowing the formula tells me when I do this, what am I solving for? What is my outcome? The monthly principal and interest. So if I was solving for annual, then I would have to divide by 12, right? But since the problem tells me, how do you find monthly principal and interest? That's what you're solving for once you do that. Thank you. As long as you see it now. And I make mistakes too. We're all human. Quite frankly, I don't care if you make a mistake, just get A, B, C, or D right. Your monthly debt service is your principal and interest payment. Your monthly debt service is your monthly principal and interest payment. Debt service is principal and interest. So now back to, let's hold your place in the book just for 1 second. And let's go back to the end of 14, page 387. Let's go back to page 387. Those 3 problems we talked about a few minutes ago, I said you don't have all the information you need just yet. Now you do. Because to do those 3 problems, you're going to have to find the monthly principal and interest. So now you have what you need to do those 3 problems on page 387. So proceed and have fun. Okay, the last piece of math in unit 15, I feel the need to tell you the story about this first. The last piece of math in unit 15 is not in unit 15. As a matter of fact, it's not anywhere in your book. What's the story? The math that we're getting ready to do is how we can qualify a buyer. So if your buyer needs to see a property right now and you can't get a hold of the lender to see if they qualify, we're going to go through the steps on how we could do just a quick qualification. I'm making no guarantees. I'm not offering any pre-qualification or pre-approval. I'm just trying to get an idea if I think by looking at their numbers, they can afford the home. So is it worth my time showing it to them? Qualifying a buyer math used to be on your state exam. It was in the book. It was everywhere. You could find it on your study material. Probably about 4 years ago, they said, we're taking qualifying a buyer math out. So they removed it from your book. They took it out of everything. 2 years ago, they said, yeah, we need to put it back in. And it hasn't made it back in the book yet. So why are you not going to find qualifying a buyer math in your book? They thought they were done with it. Y'all should know me well enough to know by now that not only are we going to go through it and work it together, but of course I got practice for you guys. So even though you're not finding it in your book, and you won't, stop looking, even though you're not finding it in your book, I got you covered. The other thing I have to say about qualifying a buyer math, I'm getting ready to give you guys another present. You will not see qualifying a buyer math on my end of class exam. Whoa, what did she just say? You're not going to see this math on my end of class exam. However, you may see it on your state exam, which is why we need to go through it right now. I say this to tell you guys, for my test, we're going to go through this, we're going to talk about it, we're going to have a conversation, but I do not want you to get bogged down on it until you're ready to go take your state exam. Then you come back and you review it and you put it into your study time. Everybody good? Everybody good with what I'm telling you? Wonder what kind of presents I can give you guys next week. Okay. All right. So we'll see, right? Who knows? Should be like cupcakes or something, but I don't know. All right. So let's talk about qualifying a buyer math. First off, we mentioned these ratios earlier, particularly when we qualify a buyer with the math. We're going to focus on conventional. And if you see this on your state exam, you'll probably see a conventional. They probably will give you the 28-36%, but I cannot make a guarantee. The 28 and 36% ratios allow us, if we have to quickly qualify a buyer, it allows us to look at the two pieces of the buyer's numbers. The 28% refers to their housing expenses. The 36% refers to their reoccurring obligations. So housing expenses are their projected principal and interest, taxes and insurance. If there are any HOA dues, and if it is a conventional loan of 80% or higher, what is the monthly principal and interest payment? When we look at the housing expenses, what this 28% means, let's pretend that we have pi. And what this 28% means, if this whole pie represents the borrower's monthly income, the pie represents the borrower's monthly income. How much money do you and your significant other make? What is your monthly income? And in order to qualify, what the lender says is for you to qualify for this loan of your entire monthly income, 28% can go towards housing expenses. So of your entire monthly income, how much can we devote of that pie to your housing expenses? No more than 28%. The second pie looks at the borrower's reoccurring obligations, which include their housing expenses plus their reoccurring debt. So in addition to PITI, HOA dues, and PMI, in addition to all that, we're also going to look at all the debt, all the bills that you pay every month, your car payment, your credit card bills, student loans, alimony, child support, medical bills. And what the lender says of your entire monthly income, they will allow 36% for reoccurring obligations. In order for a buyer to qualify for a loan, they have to meet both income ratios, or excuse me, debt ratios. So in order for a buyer to qualify, they have to have housing expenses 28% or less of their monthly income, and they have to have reoccurring obligations of 36% or less. In order to qualify, they have to qualify under both. Let's think this through for a second. If you're going for a loan and you're looking at your housing expenses, 28% of your income pie, and 36% reoccurring obligations of your income pie, all we've done to this point is paid bills, right? Have you eaten dinner yet? Have you put gas in your car? Have you put money aside in case your water heater blows up? Have you gone, on vacation? All those other things that you have left to do. That's why they put a limit on what you're allowed to spend on housing expenses and on your reoccurring obligations. For most people in this country, what prevents them from getting a loan is, without a doubt, all of our debt. Because the lender's saying you're already obligated to pay the credit card company. So if you're paying the credit card company and that debt has you over 36%, how are you going to eat and still pay me? How are you going to pay your power bill, your internet bill, your Netflix subscription, Paramount Plus, Disney, all that stuff? You guys with me? The lender's asking, how are you going to pay me and still live. So they put limitations on, and that's what the qualifying ratios tell us. Of your monthly income, 28% can go towards housing expenses, and of your monthly income, 36% can go towards reoccurring obligations. Questions so far? When it comes to qualifying a buyer, we can use a T-bar. Reoccurring obligation is your housing expenses plus your reoccurring debt. Yes. To qualify a buyer, we can look at their monthly expenses as part of their monthly income. Does everybody see the word monthly? Monthly expenses as part of their monthly income. And as a matter of fact, when we are qualifying a buyer, when we do this math first thing Tuesday morning next week, we are actually going to use two T-bars. We're going to use a T-bar to look at the 28% housing expenses and a T-bar to look at the 36% reoccurring debt. 28 and 36. I'm not sure where the 64 came from. So when we do this next week, we're gonna do one together. And then when we start, we'll come back, do a quick review. No, you do not add them together. No. You do not add them together because the lender's looking at two different things. Housing expenses is one thing. How much home can you afford? Remember, you're shopping. You haven't committed to a payment or a home yet, right? So you're shopping. How much home can you afford? And then how much home can you afford as it relates to your recurring debt? Correct. This is not in the book, but it is in the syllabus. And the Real Estate Commission says if we follow the syllabus, we will have covered everything you need to know for your exam. Do not add them together. It's two different things that the lender looks at that they have to consider. So let's look at one real quick together, and then we'll look at a few more first thing Tuesday. And well, you know what? I hate to do that. Never mind. I'm going to change my mind. We're going to save this for Tuesday. You guys get a couple extra minutes today. I don't want to rush it. So let's talk about what next week's going to look like. We're going to finish 15. All we have left to do in 15 is qualifying a buyer math. And we're going to go through it pretty quickly because you guys are not going to see this on August 30th. Is everybody good with that? You know, you got your formulas, start studying your formulas. I need to cover it, but that doesn't mean I have time to spend right all morning on it. So we're going to finish 15. That'll get us through. Qualifying a buyer math will get us through. After 15, y'all please write this down. If you guys are looking ahead next week, after 15, we're going to do unit 21. And then we're going to do unit 17. And then we'll do 13. We will do 11. And we'll probably get through most of 12. 21, 17, 13, 11, and 12. As I mentioned earlier, y'all, 13, 11, and 12, they're not near as intense as 7. We're not spending 2 whole classes on units 11 and 12, right? Things are going to start picking up and going through them because the weight shifts. You may see a few test questions on unit 13, but you're not going to see as many as you do on unit 7. I never asked you guys to read. I know how that works out for me. All I asked you guys to do is look ahead. That's all I've ever asked you guys to do is look ahead. Do I think you should read? Well, I don't think it hurts because you're going to be tested on this stuff. But if you look ahead, it'll help prepare you for next week. You guys, please remember to breathe. I get it. We're overwhelmed. It's a lot of information. Did I not tell you that on day one? Something about a lot of information. Did we not heft this thing and say, my God, this is a lot of information? I was not kidding. I joke about a lot of things, but it ain't this. Time's marching forward. I need you guys to buckle down. I need you guys to take that midterm. I need you to have a true snapshot of where you are. Fair? Let me know if I can help. Let me know if you have any questions. Y'all have a good weekend. Have a good weekend. Thank you. You too.
Can we go over like another one of the discount point problems where you have to find the rate?
I mean, of that, you know, I'll be happy to go over it. I don't want you to get too worried about it. Let me see if I can't find one real quick, which I don't even know. I may have to make it up because I don't even know offhand where you may find it, but absolutely we can look at that interest rate again. So let me just kind of make something up off the fly here.
That was the one that really threw me off today.
Sure. And remember I said, if you see it on your test. So discount points. So let's just say the problem says, are you good with finding the loan amount, using the loan to value ratio and finding the loan amount? Okay, all right, so let's just say that the loan amount is $450,000 and the lender is charging 2 discount points and the borrower's interest rate is, let's do 3.5%. So they tell you the loan amount, they tell you the number of discount points, and they give you the interest rate. So the thing you will see, mark my words, the thing you will see is how much will they pay in discount points at closing. So when you see 2 discount points, what does that shake out to? 2 discount points shakes out to let's see.
0.25, I think, right?
It's going to be, yeah, 2% of the loan. The number of discount points is the percentage of the loan. So my loan amount is 450,000. They're charging 2 discount points, which is 2%. So how much extra will the buyer bring at closing? They're going to bring $9,000. That's one piece of it. And that's what you will see like next week when we get into 21. Okay, so that's
Okay, I was doing too much work. Like I was doing.
well, I'm
too
not
much to
done yet,
try to
but I'm not
figure
done
that
yet.
out.
I'm not done. That's just one piece of it. Discount points is the loan amount times whatever percentage that is. So so far so good. Is that okay? The second piece of it that you may see, and again, hear me stress the word may. The second piece of it that you may see is, what is the borrower's new interest rate? So when they buy, their interest rate now is 3.5%, right? When they ask what the borrower's new interest rate is, or what the lender's yield, what the new lender's yield will be, that's when we break out discount point pie. So if we have 2 points, 2 points is equal to 2 pieces of pie. And discount point is always of 8s. So if you have 2 pieces of pie, you're looking at 2 8s. 2 pieces of pie, 2 out of 8, right? 2 divided by 8 gives me a number that I can work with of 0.25. So bringing $9,000 extra to settlement, prepaying interest of $9,000, you're buying down your interest rate by 0.25%. So where your interest rate was 3.5, you paid $9,000, you prepaid interest. So you bought down your interest rate by 2.5%, which means your new interest rate will be 3.25%. And that's your rate lock. That's will be, again, you don't have to worry about that unless they specifically say, what is the buyer's new interest rate or what is the lender's new yield?
Okay, it just clicked for me. Thank you.
Good, good. And what were you said you were doing more work. Don't do more than what you have to. You guys
I
already
think
have.
I was trying to take that new number, that new percentage, and I was trying to put it back into, I'm getting all my formulas are starting to blend a little bit. The T-bar definitely helps kind
Good.
of break it down and make it more simplistic for sure.
Get all those formulas on flashcards and maybe even keep them separate than your other flashcards. You know what I'm saying? Separate them out so you can keep those formulas separate. I mean, something else you may want to consider is taking you a piece of paper in your notebook and calling it formulas. And, you know, John, so that way you have everything right there in a nice, neat little package. Once we get through 21 is 14, 15, and 21 are heavy math, you know. After 21, we got a little bit of math left, but nothing like, you know, so the good news is we're almost through the big math, just a little bit more afterwards. So I suggest I say keep them together, but if you have them so you can, you know, this is how I find how much prepaid interest the buyer is going to pay at closing. This is how I find what their new interest rate is going to be. So you have them separate, but together, kind of in a nice, neat little package.
Thank you very much.
Of course. Somebody asked a great question, basically about our safety. Next to last thing we talk about in this class is agent safety and things we can do to protect ourselves, because the truth is, y'all, we're opening ourselves up to the public. And there's crazies in the public, yes. So we always, you know, safety first. There's no amount of commission worth your safety. So we'll talk about safety and things you can do. Specifically, can you carry or conceal carry? Unless your firm has a policy telling you no, telling you you can't, which if it's concealed carry, how do they know, right? You know, but some firms may have policy, but even that policy would be having your concealed carry on the firm's property. So when you're out showing property, can you carry? Yes, as long as you're comfortable, as long as you know what you're doing. If you don't know what to do with a gun, please God, do not go get a gun. But you can have a knife, mace. You know, I absolutely think everybody should have something when they're dealing with the public just to protect yourself. So I do have, in a couple weeks from now, we'll talk about safety because it is oh so very important. Oh, so
Yeah,
very.
I've watched too much Dateline and seen the realtor one
Stop
with
that.
the
There's
realtor one freaked me out, where she was the realtor and her assistant or something ended up murdering her and leaving her in the trailer. Like, it was crazy.
Yeah. There's a horror film on Netflix called Open House, and I refuse to watch it because I have no idea what it's about, but the name, I'm like, I'm good. I don't want to. But it is very real. As a matter of fact, this is good timing for us because National Association of Realtors has claimed September Safety Awareness Month, because unfortunately there was an agent a couple years ago in Arizona that was raped and murdered by her buyer client when showing property. So it's a good opportunity for us. We got to be aware. We got to trust our instincts. We got to, you know, protect ourselves. Like I said, there is no amount of commission worth your safety. And so that's why we'll talk about that. should I not worry about housing expense and reoccurring obligations? I mean, if you want to look ahead, my PowerPoints are in Learn Test Pass. So if you want to look ahead at qualifying a buyer math, you're welcome to, but we will start with qualifying a buyer math on Tuesday morning. Heard a story about a broker walked into a kitchen showing a property and there was someone asleep, that they had a needle in their arm. Yep. And they just backed out quietly and called the cops. Absolutely. Absolutely. Yep. I walked in the front door once and the back door was hanging wide open. I said, let's back up for a second. Was it open because the wind blew it open? Pressure in the house, or did somebody try to get in the back door? I have no idea. And I'm not going to be the one to stick around and check it out. So we've got to pay attention. Absolutely. Spent time on guys, remember, what's your homework every single time? Review where we've been and cover where we're going. The stuff that we've already covered, you're going to be tested on. So should you go back and review it? Sure. But we're not done with stuff yet. I had an agent once. Oh, I hate this story. I had an agent once. She got a call from somebody to see land. And to get to the land, you had to go like that down this dirt road. So she went out to meet him to get land. And once she got out there, she just got that uneasy feeling. The gentleman she was showing it to was by himself. It was just her and him. And so she pulled up, she didn't get her car. She rolled her window down and she said, I'm sorry, I got a family emergency. I have to go. We're going to have to reschedule. And she got out of there. So then she got home and she started second guessing herself. Oh, I'm so silly. Why did I think that? You know how we do, right? We second guess ourselves. So the guy called the next day and he said, I just wanted to check in. I hope everything's okay with your family. And she said, oh yeah, we're good. And he said, well, I really want information on this land. Would you be willing to meet me again? So she went out to meet him a second time. And the second time her husband said, I'm coming with you. And she went down that little dirt road and that dude took one look at her husband and said, now I'm good, never mind. And that story to this day, just, I mean, chill down my spine right now as we speak. Thank God for her husband. Did he have good intentions? Even though he sounded like it sure doesn't seem like he did he? So, you know, part of what we're doing to get, I mean, we're putting ourselves out on the internet, we're promoting ourselves, we're throwing our picture out there and, you know, not all people we can trust. So we just always need to.
Then maybe you don't want to be alone at open houses. Maybe
have a friend. And that, yep. So, you know, with open houses, if somebody from your office, if you can't have a coworker join you, then, you know, bring a friend or a family member. Just make sure they understand their role. They're not the one with the real estate license, right? So their role is just to sit with you and keep you safe. It's never suggested that you meet a buyer somewhere by yourself at a vacant property for the first time. You know, get them into your office for a buyer consultation, or if nothing else, meet them at Starbucks, you know, so you can, you know, if they're not willing to meet you at Starbucks, if they demand that they just meet you in the home, I just got to question their intentions, you know. I mean, I've shown property before, like evenings where my husband comes, he doesn't get out of the car, he stays in the car, but they see him, you know what I'm saying? So safety in numbers, absolutely. How do you show if you're concerned to go in? Do you call someone or risk it? Yeah. I mean, like I said, if they're not willing to meet you at your office or a public place, for me, that would throw a flag up for me. I would question, why are you not? Because if I can meet you at Starbucks, can't we start talking about what you're looking for? We can do our working with real estate agents, right? I can have excuses to meet you at Starbucks. And if you insist, if you will not, I've got to question what your intentions are. I have to. So yeah, can you just bring someone? Of course. And you know, once you meet buyers a few times, you start building that, you know, we're in and out of our buyers and sellers' lives so fast. I mean, how well do we really get to know them anyway? You know what I'm saying? So when I do an open house, because I too have my concealed carry. When I have an open house, I have my piece, but on my person, I have my mace and I have my car key with my panic button, because I'm not trying to hurt somebody unless I have to. My objective, my goal is to get away. So if I can run to the car and set off my panic button in the meantime, then I can get away. I have a taser, or I'm sorry, a flashlight with a taser on it. That was a Christmas present one year. You know, so there's just, and it doesn't look weird for a real estate agent to carry a flashlight, does it? So it's not like it like stands out as a red flag to anybody. So you got to take some steps. You got to take some precautions. And like I said, we'll talk about that at the very end. It's a non-testing topic, but it's probably just as important as agency, right? Keeping everybody safe. At the end of the day, I don't know about you guys, but at the end of the day, I want to come home tonight and have dinner with my husband. And I'm going to do whatever I take to come home tonight and have dinner with my husband. Whatever precautions. Yeah, that's one reason why I do. You know, women's pants, man, it's hard to find us nice pants with pockets in them. Men don't know how lucky they have it, you know, but they're out there. So like, I won't show property if I don't have pockets that I can at least put my mace in, you know. So I may have my piece in the car or something if I can make sure to run to the car. But I mean, I've had times where I take my purse, where I have my gun in my purse, and you know, I have that and just keep it on me, you know. So it's I think it's definitely harder for women to can carry than men. But there are things, I mean, you can get you a nice little, you know, holster and keep it in your pant line or your waistline. I mean, you know, and if you're going to conceal carry, you've got to practice. You've got to practice using it. Don't just pick up a gun for the first time and say, I'm going to get my concealed carry. You got to go out to the shooting range, and there you go, flowy shirts. Yeah, you got to practice with it. We do date night regularly. We go shooting, and then right across the street is a Mexican restaurant. So, you know, we get the best of all, of all worlds. But it keeps us in practice. It keeps us. And guns are meant to be shot. I mean, if you have a gun and you never shoot it, you don't know what's going to happen when it does shoot. So absolutely. You guys have a good weekend. Unless you have any other questions, then I'm still here and we're still recording. So. PMI, of course. PMI is private mortgage insurance, and we see that on conventional loans, and particularly conventional loans with a loan to value ratio of 80% or higher. So remember the loan to value ratio, this is through the eyes of the lender. So the lender's asking themselves, of the value of the property, what's the percentage of the loan? So if the loan to value ratio is 80% or higher, you are more risky to the lender. So let's say we have our purchase price, or let's do a loan amount of $100,000. Loan amount of $100,000. And no, I'm going to change my mind one more time. Sorry. Let's say you have, there we go, sales price of $100,000. And let's say you are asking the lender for 80% of the loan amount, of the value, excuse me, 80% of the value. So if you're asking them for 80%, really what you're asking them for is $80,000, right? Because you're asking them for 80 cents. So if they are bringing 80, then you're bringing 20, right? The lender's got to protect that $80,000. They have to protect, they have to know that if you never make your first payment, you never make your first mortgage payment, can they sell the house for $100,000, pay, remember our distribution of proceeds, pay the cost of the sale, and then pay our government taxes or special assessment, and recoup that $80,000. The closer your loan amount is to $100,000, the less chance the lender has of recouping their funds. Because remember, in the event of foreclosure, the lender is third in place. The trustee gets paid first, then taxes and government special assessments, and then the lender. So they have to make sure if it's 100% loan and you default, they're going to lose money because they got two other people standing ahead of them. Does that make sense? So the more you pay down, right? So let's say you originated at 80% and then you pay it down, da, 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 da. Fast forward, 10 years, 15 years, whatever. And now you're down to $50,000. You're less risky to the lender now, right? Because now they can sell your home for presumably whatever the value of the home is today. They can sell it today, pay the trustee, pay the government, and then still get their $50,000 back. So the reason that they charge PMI on anything 80% or more is to protect their interest. And the higher the loan to value ratio, the higher the ratio, the more risky you are to the lender. So as you pay that down, if you originate a loan at 75%, I mean, they're still worried about getting their money back, but they're not as worried about it, right? If you originate a loan at 90%, now they're bringing $90,000, and that's when they're going to charge that PMI, which is insurance for them, the lender. So they're collecting a little bit extra for you until you get to that threshold of 80%.
Okay, that makes sense. Thank you.
Sure.
Could you also go over the seller financing? Because I know you said that the seller is providing the funds or something like that.
Sure. Let's see. Hang on, I got another question ahead. If you are renting, how does that qualify a buyer? We'll cover that. Not really. How much rent you can afford and how much mortgage you can afford are two different things. So how much rent you can afford is pretty much up to you and the lender, right? I'm sorry, the landlord, because the lender's not involved. And I do think that it is a common misconception that people think, well, this is how much I pay for rent, so this is how much mortgage I can afford. But the lenders, that's not the math that they use. They use that qualifying a buyer. So those are really two, or need to be two separate things. I'm sorry, Ashley, short-term memory. What did you just say?
Let's talk about the seller financing.
Seller financing. Thank you. Sorry about that.
Yes, ma'am.
My little brain, I swear. So seller financing is also known as a purchase money. RTG. So purchase money mortgage is seller financing. And with seller financing, the seller's acting as the bank pretty much. So we don't have Bank of America or Wells Fargo or whatever. We just have the seller. So the buyer's going to buy, they're going to get the deed, they're going to become the owner. And they're not, instead of making payments to the bank, they're going to be making payments to the seller. The seller is acting as the lending institution. And if we compare seller financing to installment land contract that we talked about at the end of Unit 10, again, the buyer's still paying the seller, right? They're not paying one lump sum, they're paying in installments. So they're still making payments directly to the seller. The difference in the two is when the deed changes hands. So with the seller financing, the buyer gets the deed at closing. So in seller financing, technically, if we go to closing today, they're the seller and the buyer, right? Tomorrow, they're the owner and the previous owner. So now in seller financing, the owner is paying the previous owner. In an installment land contract, the seller still owns the property. So in an installment land contract, the buyer doesn't get the deed until that last payment is made.
Makes
Installment
sense.
land contract probably has better protection for the seller, because in the event of your default, I don't got to go through foreclosure. I don't got to take, okay, you defaulted, get out of my house. I still have the deed, so it's my house, get out. I keep any money I've already collected from you. It's not like I have to pay you anything back. And now I can re-rent or resell the property because the deed's still in my hand with installment land contract. What did you
Okay.
start to say?
I said that makes sense. Thank you for that.
Good, good, of course. Good. Y'all, I get it. It's a lot. I sat where you sat once, you know, I get it. It's a lot, but it's a commitment. It's a commitment. It's like a puzzle. That's how I think of this class, is like a puzzle. All the pieces are coming together.
Thank you again. Have a good weekend.
You too. Thank you. Have a great weekend. Thank you. Isha, you still there? Good. You have any other questions? Great. Have a good weekend. Let me know if I can answer any questions.